Good morning, folks. Just waiting for an audio check. You guys can hear me on Twitter. Just give me a heads up, 5x5 if you hear. I can hear myself on the playback, so you should be seeing or hearing me fine. Thank you, Leon. Thank you. All right, so we're running a little bit late here. I got a new microphone. Okay, so I'm trying to make sure everything's set up appropriately, and we've had a large expansion overnight, and we are looking at the ES future contract for June delivery. So on TradingView, your symbol, so that way you can track it on your own. That's your symbol right here, okay? So you enter that into TradingView. If you have live data, you'll be able to see what I'm showing you here. Otherwise, just track it with what I'm showing on my stream. All right, so one of the things I'm looking at is this low here. And I'm going to have these in a color I usually don't like to use. Not that there's an issue with it, but okay, so right now on the daily chart, this is our dealing range. And dealing range is where we are in terms of the high and the low is most salient at the moment. Meaning that yesterday's up close, that high, that's important to me. And this low is important. This is the dealing range that we're presently within. We've already worked this wick here today. So I'll be watching to see if they want to revisit that as well. Okay, so the consequent encroachment of that wick comes in at 38.67 and a quarter. And the low came in at 65 even. That way we can delineate what that level is when we drop in the lower time frames. Okay, so it's this consequent encroachment of this wick here, and with this information here, if we happen to trade lower, and I don't suspect that we are right now, but if we happen to go below this low, then my attention goes over to here. Okay, but let's drop into hourly chart. All right, so we had a difficult time trying to get through the 72s. This high over here comes in at 78 and a quarter. High yesterday came in at 72.50. Failed here, rolled over. There's a lot of news about obviously the banks failing and such. And it looks like the narrative is they're trying to get folks upset, worried, and instilling fear. So we're not worried about any of that stuff, but because you're not going to stop it if it does. So worrying about it doesn't make it any better. One of the things that I'm looking at is obviously there's a lot of smoothness up here. And with the drop overnight, we've taken out these lows here. So right away, I want to let you know that I'm in no hurry today to draw a hard line bias. Yesterday, I did a fairly good job of walking you through live action multiple times pretty precisely. So if you haven't gone through my Twitter yesterday, you might want to do that and drop the tweets into your TradingView chart, and you'll see that the precision was on par. This magnet thing is strong. Take that off here for a second. Okay, so what I'm looking at these lows here and this low here. So it's kind of like three lows relatively equal. We went down below that so far today. We have SIBI here, sell side imbalance, buy side inefficiency. So we're watching to see how much of this range in here we want to revisit. Right now I'm showing electronic trading hours, so I'm going to toggle to regular trading hours. So you can see the difference in here. This is where we're opening versus where we closed yesterday. So there's a significant discount from yesterday's close to now this morning's opening. When it's this, well, prominent, I would look to the low of the last candle. So we'll be noting that here as well. So this is what I'm typically doing in the morning session that you don't see all behind the scenes and such. I don't have these levels really drawn on my chart unless I'm recording an execution, so that way you can kind of like follow along. But the logic is we could revisit this here, and that, in my opinion, would be a gap closure. It doesn't require going all the way back up to yesterday's closing price using regular trading hours, okay? So in short, what I'm saying is we have a soft bias to return potentially to 39.1450. That's my interest. That doesn't mean I'm going to go long. It doesn't mean that you should go long. It's just that's what I'm watching. That's what I'm monitoring. So at that level here, I'm going to make that level black just so I can keep track of what it is for me. And I'll make it a little bit thicker than I normally would. Okay. So we'll drop back down into electronic trading hours now. All right, so now notice also by having that 39.1450 level annotated, which is the last candle of yesterday's trading before the session ended for regular hours, that also is really close to what on this candle's wick, consequent encouragement. So while it could dig up into this range more, it could go as far as this previous day's last hour trading candle and what happens to be consequent encouragement on that wick. So let's drop into a 15. On a day like this, where we have such a huge move overnight, your first rule of thumb is slow down. In fact, it's better for you to actually anticipate trading the afternoon session, because the morning session, usually it chops around, it gives false moves, then consolidates and just does a lot of potentially seek and destroy. Seek and destroy is where it goes above short-term highs, below short-term lows, and goes right back to the middle. And then later in the day, there's this big expansion move where it draws to liquidity that hadn't been tapped for a while. So I'm not comfortable yet giving you a bias. Like when I tweet, I'm pretty much confident about what I'm saying because I wouldn't tweet it otherwise. And it's predominantly correct. Here, the rules and protocols that we're utilizing is right out of the notes, what I teach on my YouTube channel. My students have been with me for a long time. They know this is not something being form fitted for today. Whenever there's a large move or a large range, the very next morning session, you have to be very careful not to try to go in and chase because we've had an expansion. And what that means is, look at the ranges here on these candles, the sizes. Okay, relatively small. And then as it drops, it gets large. So we had this big movement lower attacking sell side. We've not been able to trade above the 39.7250 level. We failed to get above that here. And just overall, this weakness rolling overnight. Because it's moved so many handles, and a handle is a point. One point would be 38.71 to 38.72. That's 4 ticks. We've moved about 90 handles or so. Just almost about 100 handles. That's a significant price move. And to do it all in one session overnight, in the London session going into the early hours of New York session. You just want to be careful. Don't try to chase it, in other words, and try to avoid trying to pick a reversal either. If I could go back in time and show you where I've done the most damage to myself, it's trying to chase these moves after they've happened. And you just got to be very, very careful not to do that. So I'm going to walk you through this morning as best as I can based on what we're looking at. But my interest, and I want you to know this going forward, my interest is in the afternoon session. So 2 o'clock to 4 o'clock in that 2-hour window. So you're probably asking yourself, why didn't you want to just do a live session then? Because I have a family and I have things I have to do today. So I'll be tweeting to everyone through my phone, walking around looking at charts from my phone. But it's important for you while you're here going through this mentorship to learn how to navigate. So that way when I stop doing these at the end of the year, second week of November, you'll have a procedure to follow yourself and rules that you've utilized, watch me utilize, and you'll understand why those rules and procedures are even in place. So there's a fair value gap that lines up exactly with this mitigation block. Now, mitigation block is, think of like a breaker. Most of you understand what the breaker is. It's a high, if it's bearish, a high, a low, and a higher high, and the low in between. Inside that low, when you drop down to a lower time frame, the down close candle in that low, that would be the bearish breaker. In this case, we have a high, a low, a lower high that eventually went through. That is mitigation block. Mitigation is a failed breaker, but they operate the same way. So in other words, treat it like real support and resistance. It's not a matter of looking for where the market turned in previous data. That's unfortunately the misinformation that books and other educators, and I fell victim to that too in the beginning, looking at just where the market turned around before and thinking, okay, that's support, that's resistance. There has to be some context as to why there was a turn there. And in this instance, this high here ran through liquidity over here, came down, tried to rally once more, and was unable to get above the previous high, even through all this. So anyone that would be long here, once we drop down below it, the concept of mitigation block is the same with a breaker. If someone on an institutional level is long, when it trades back to this level here, it allows them to mitigate that potential losing trade or drawdown, meaning that any longs here that are underwater, that means they're holding on to it while it's dropping against them. When it returns back into it, it's offer them an opportunity to mitigate. Order blocks don't mitigate. Okay, price isn't mitigating. I hear a lot of folks in the community and outside my personal community, and they'll say those types of things. And mitigation, that word is thrown around a lot when it's really mislabeled. So the object is, because this market rallied here but failed to take out that high, and we have a fair value gap there. Our focus is to watch this one here. Now, more specifically, if we get through this fair value gap, and I'll draw it on the chart now. You can see how we're gravitating to it now. Just like magic. Okay, so the fact that we pulled back up to this level, and it's a fair value gap, this level here to me is important because it can act as resistance. It can fail. In other words, fail to trade through it, which is what we would reasonably expect, because longs here that are underwater, they're going to want to do what? Get out of it. Not that it causes the market to go down because of selling pressure. It's allowing, the market's allowing those individuals that are using things outside of retail to get out of that long position. So what I like to do is I like to read the interpretation of each PD array, where they lay out in the chart. And because we are in a day or a morning session that has seen a large range expansion overnight in the London session, it's going to be a hard sell for people to want to be long. Now, it doesn't mean that the market can't go higher, but I want to see a lot of things in my favor that would support a run. If I were being honest with you, I'd like to see it run up and take out the 65 level, 39.65. I'd like to see that. It may not do that, but I'm watching that today because I'm very leery to trust what's gone on so far this week. And I mentioned on Twitter that this week was going to be, more difficult than most of you are prepared to navigate because you're either new or you're not used to this much manipulation. And there's a lot of that right now, lots of it. So what I'm watching is, do we respect this fair value gap with the mitigation block? Because the narrative would be this. We go up here to allow smart money to offset their longs that they had here that were unable to get off. Now, you're probably thinking, okay, if they're smart money, how did they end up in a position where they're losing? Because they're human. They're going to do what? They're going to speculate just like any of us would. And they may do something wrong. They may have a bad day. They may not be firing on all cylinders. I mean, they're not artificial intelligence. The AI is the algorithm that's delivering these price movements. It's not the buying and selling pressure. But the participation of this group of traders, they're looking for these types of things in price action to instigate some reason to be long or to get out of their position, or to get short or get out of their position. And so, while that's not a lot of movement here, as a new student, you want to start with those small little incremental milestones, looking for things that draw to why price should be reached to a specific level. Why should it react or behave a specific way? Now with this wick here, okay, see this wick? When we trade above that, I like to use the consequent encroachment of that as well, because we can have a retracement down, and it has 92.75. And this level to me would be important. I'd want to see it. It can stab through it a little bit, but I want to see if it trades down there. I want to see the body stay above it. And we'll make this thinner. Okay, and I think we've got enough here on the 15-minute time frame. We do have another imbalance here. Look at this right here. This is for folks that are struggling with my fair value gap. Look how this candle's trade down. The next candle we trade up, and then down. The next candle we trade up, almost completely closing in to that previous candle's low, and trade down. That's efficient delivery. There's no fair value gap here. It opens here, trades up almost to that candle, and then trades down. The next candle we open, we trade up and leave what? That small little gap right there. See that? So if we do manage to get above this fair value gap with mitigation that's bearish, this would need to act as support, and then we would need to power through this one if we're bullish. This one here is just the first point of interest. I'm only interested in to see initially what we're doing because we're not rushing. We're still in the opening range. It's not even been 30 minutes since we opened. So we're only trying to get a feel for what it's likely to do, but not getting excited because why? We had a big move overnight. Every retail trader in the world is going to be wanting to do what? Chase it. Chase it where? It's been going down. So you have what? Stop loss orders that are resting right above this wick. They ran to that, to a fair value gap I've outlined with the logic as to why it should go to that one, because we have a mitigation block over here. So it's not just simply a, oh, this looks like a fair value gap, let me just put a rectangle on it and call it a fair value gap. No, there has to be some context as to why it would be even returning back to that level. Just because there's a gap, for instance, there's one up here, there's one right here, very small portion of it here, very, very low. It's the low in that candle, 33 even, and the high on that comes in at 32. So it's a quarter of a point of a gap, but it's the gap nonetheless. The fact that we are in this area down here and this one here, why would I be interested in those and not suggesting something up here? Because if you look at the run from this low that we've created for the day, from the high overnight, where is these two fair value gaps? In the lower portion. So I'm wanting to justify, if smart money tried to go long here and they're utilizing this fair value gap and mitigation block to mitigate that long position or positions, they are thinking what? If that's true, if we can't get above this, it's being tipped, the market's tipping its hand that longs shouldn't be favored. So therefore, we could potentially grind eventually down into this low again today. I don't know that yet. I'm still observing the fair value gap, that mitigation block, and if we drop down any further, this is where I would want to see it stop. Right in here. It can touch, the wick can touch this candle's high. That would be if it did it all in one candle like this, that would be referred to as my immediate rebalance. Next candle, when you have a big up candle or down candle, the next candle opens and trades all the way back to the previous candle's high or low, creating no gap at all. That's an immediate rebalance. Usually when you see that, that's one of the sharpest, quickest takes off runs, and it doesn't give you a chance to get into it, which is important when you watch these big runs like this, because not that this is a big run, but it's significant because we've had a lot of range movement intraday. Yesterday there was so much speed in how fast the market was moving, and I'm training you to look for 5 handles initially, and man, that's happening in like seconds. It's like boom, boom, they're there. So you have to be really, really careful right now. Just to further, I probably confused some of you when I mentioned this range and what I was referring to. That's 50%. Okay, so this one here is still in a discount. So I want to see, does it have a reluctance to get to even 50% of that range, which would be what? Equilibrium, or above it, which would take us into that fair value gap, which would be what? Premium, relative to this high and that low. We don't need an indicator to show us that, you know, getting up to this level here would be short-term overbought. So I don't need indicators to tell me that. I'm looking at the range and determining where I am in regards. And I'm eyeballing this. I'm not drawing this, you know, you'd need to do it because you're learning. But you can rough eyeball it after you've been doing it for a while and see, okay, this is about midpoint. And this fair value gap would be premium. So what I'm suggesting here in terms of narrative, what I'm trying to flesh out in terms of what I think is likely to occur, is the fact that this fair value gap we've outlined and that mitigation block Smart money was what? Potentially long here. They went underwater, so they're in the business to make money. When the algorithm allows price to reprice back to an inefficiency and mitigation, they'll do what? They will kill their longs, and those longs being neutralized is indication to me as a trader, if it can fail here, that the better side is still looking for lower prices. And it would have done what? It would have gone up to take out the protective buy stops that were trailed in any shorts overnight. Retail would be trying to go short, thinking that this is resistance because it went there and stopped on a lower time frame chart, because everybody's using 1 minute charts now. And this run here perfectly takes out any trailed buy stops, but it goes to a level that's, in my concepts, that makes sense. It's inefficient, mitigation. So far we've seen movement here. It's already moved what would have been considered what? A 5-handle run or more. I mentioned that the wick, it would trade down into that. If it does go lower, I want to see it go there. Now, some of you might look at that as, that's a model. That's enough for me. It makes perfect sense to me. And if it repeats these conditions in the future, you can practice with that. I'm going to drop into a 5-minute chart. Now notice on the 5-minute chart, it doesn't look like a fair value gap. That's one of the, I get this question many times from new students. How is it when I drop down the lower time frame, the fair value gap that I have noted, there isn't a fair value gap on the lower time frame? That's fine. You would sometimes see that because these intervals are going to be much more busy. They're going to fluctuate a lot more. So they're going to overlap. You got 3 of these 5-minute candles that make up one 15-minute candle. So the fair value gap that I've outlined on that previous chart on the 15-minute time frame, you can't really see a fair value gap here except for the small little separation between this candle's low, which is 3909.5, and this candle's high, which is 3908.75. So it's 3/4 of a point, or 3 ticks. But that right there, that small little gap there, can be refined. So if you were looking at the 15-minute time frame, fair value gap, and drop down, you would refine it to that area right there, because that is the actual fair value gap. So that's calibrating your PD arrays. You go from higher time frame down to lower time frame. And you can see how we go right up into it, hit it perfectly, and then we drop down to the consequent correction of that wick there. So from high of fair value gap, 09 3/4, which is this candle here, to 92. So that's plenty range to just get your 5 handles and move to the sidelines and just wait. Using the logic that I've outlined here. This would be mitigation. Smart money would be doing what? They would be killing their longs that would be underwater as it dropped down below. And we are doing what? We are not even returning back to equilibrium yet. So in my opinion, it indicates weakness. All of these things are so far supporting the idea of weakness. Now, what I'm looking at is the dollar index. It's really not showing anything that's clear or decisive. So it's not lending any kind of intermarket analysis yet. It looks like, honestly, it could go either way. I'm looking at a 1-minute chart, and we've already ran up on the hourly, just falling short of 105 at a high of 104.959. British pound looks really heavy here. Euro just marking time at 105. NASDAQ, let's see here. Go over to the NASDAQ real quick. All right, so we have a discount array here, and it's an order block there. 2 down closed candles, and a fair value gap there. So that would be an interesting PD array on the downside for those that are watching NASDAQ. All you talk about is ES ICT. I don't trade ES. I want to talk about NASDAQ. Right, so that's a level. Be mindful of that. What is that? That low comes in at 12,182 and a half. So you can use that to study that. Back to ES. Look at that. It's almost like it's supposed to work. Fair value gap with mitigation failed to get to equilibrium of the previous range. Is there any imbalances in here? Fair value gaps of that kind? No. Just the order block. We have a low that took out sell side here, but no inefficiencies. So what we're watching is this order block. Let me draw it out. I'm using the open because it has a stubby little wick. If it had a longer wick, I would use the elements I've been teaching you with the wicks. I forgot what I'm doing here, okay. All right, so we have this range, and now how far can it go down and still not take out that low? Mean threshold, which is half of this down close candle. So you go back over to your fib. It's technical science. 38.79 3/4. So that's kind of like the last line of defense. If it were to go any lower, let me drop this here. If it were to trade through that and start showing the bodies going through it, that would be, in my opinion, indicative of wanting to revisit and maybe run out that low. So let's talk about if you were utilizing that mitigation block and that fair value gap and waiting for the market to go to what? A short-term premium. Well, wait a minute, ICT. You said that this here is equilibrium in the overnight dealing range. So as long as it's below this, we're weak, right? But look inside this price leg here, from that low all the way up to the high here. There's several price swings. From this low, looking back, forgetting this one here because that's just a small little reaction. We've already mentioned the purpose of why that would be used, which would be trailed stop losses on shorts. Above it would be buy stops. Above that, the 15-minute fair value gap, which is this blue one here, and it falls below equilibrium of the overnight dealing range. From this high, going to the left, higher than that high, where's the next immediate swing high? You can't use this one because it's lower than that high. That's not a swing high. That's a swing high, right here. So if we use that frame of reference there, this movement up to that fair value gap here, within this dealing range, which is also in what? A discount still relative to the low here and the overnight range. Now, I know some of you that are brand new, this is completely confusing to you. Trust me, the core content, go through those lessons where I'm talking about price swings and looking at how price is fractal, price swings within price swings. This is how you build narrative. This is how you do it, okay? It's not just simply plot an indicator or an indicator that's supposedly has my name plastered all over it. It's not going to do this kind of work for you folks. Okay, I know there's folks out there that are making things for TradingView and other, platforms, the ICT fair value gap and the ICT new week opening gap indicators. You're going to have lipstick on your chart, but unless you know how to use it, it's going to do nothing for you. It's going to confuse you. You're going to have more things than I have on my chart. If you use all those other indicators, there's going to be fair value gaps all up in here. I'm not looking at them. I have a process. I have to go through a process of what I'm walking you through here, which is the logic, how the algorithm is going to refer to the specific fair value gaps. It's not just because there's a fair value gap, price is going to go there. That's what separates me from everybody else that's trying to be like me, to sell mentorships and courses and such. And I hate sounding like I'm a hater because I'm not hating. I love the fact that people are gravitating to my concepts, but a lot of them are overzealous and they're trying to be educators when they don't know what they're doing yet. And you're actually hurting your own image, and you're also presenting misinformation about my concepts that you don't know. Like, you don't know it yet. But this fair value gap is in a premium relative to the dealing range from this swing high to that low. Now, think about what I was outlining earlier. The market has had a big move overnight. We do not go in chasing the market lower because it went down overnight. If we want to get short, we have to do what? At least allow the market to do what? Trade to a premium. So how do we identify a premium? We have to look at the price leg that we moved from or within recently, which is this movement down. I showed you, let me show another fib so we can keep it in context of what I'm showing you here. So from this high to that low here, this 50% level is equilibrium. That swing high happens to be where? Right at equilibrium of the overnight range. Then we have a fair value gap on the 15-minute time frame here, because I'm looking at a 5-minute chart. Remember, we dropped down. It traded up into that fair value gap. At the same time, it traded up into a 15-minute mitigation block. And the logic was, we want to see, does the market reprice lower from there? First objective would be what? Trading down into the wick of here. Then I said if we go through that, we have the order block. And then here. How could you use that as a model? How could you use that as a, if you wanted to trade this and be short, because now we've watched buy stops that would be trailed here, because as the market went lower, traders are going to do what? They're going to want to jam their stop loss. And when it started to break a new low here, buy stops will be placed right there. The market does what? It trades up into a short-term premium relative to this high to that low. And we're still in a discount market relative to the range overnight. So it's indicating weakness. So you have several things there in your favor. You did wait for it to go to a short-term premium. You did go to a inefficiency, and it's at an area where it created what? Mitigation. So because this range here is indicating overnight, that range, we haven't even made it back up to equilibrium. So we're still heavy. We knocked out buy stops. The market routed up to a fair value gap and mitigation. Consequent encroachment of this wick, target 1, target 2, order block, and then you could get this as another objective, which is not done so. And now we're working off of this order block. And so far the range hasn't been all that much, but this is still tradable. Now earlier, right here, I was not streaming at the time, but this down close candle, using the logic I've outlined here, this could have been another student of mine's model where it traded at this open down into that order block there, anticipating a run up into that fair value gap. That would be their trade, buying it at the order block level here, buying it, stop under the low of this candle, rallying up to here, and get out and be done. Trading with the logic that it's oversold without the necessity of having an indicator. Retail is going to do what? Chase it lower. They're going to want to go short. And also utilizing the regular trading hours. Remember that we were talking about how it could potentially go up to, I recall, what was it, 39.14? I lost my train of thought. Yeah, 39.14 and a half. Okay, so that could be a draw for price up there. Initially, that's what we were talking about. And back down into electronic trading hours on the 5-minute chart. So 39.14 is right there. Okay, so that was a draw it could potentially trade back up to as using the regular trading session or the opening range gap, because that's what that is. And I know I'm throwing a lot at you, but you know, it's 3 decades, folks. I've struggled to try to condense this where all the things that I utilize, you you want to learn it, I got to teach it to you, but they all have to have their own individual labels. That way you can keep track of what I'm looking at and when you use it. But that could have been a nice little long for someone that would be trying to trade against retail mindset, which is they're trying to go short because it's been going lower, and then rally up into a fair value gap with a mitigation block and a draw to 39.14, which would be the last hour of trading yesterday low. Lots of ways to skin a cat. Let me see here. If you're following along on Twitter, if what I just outlined in terms of how both sides of the marketplace using my concepts can be, I know it sounds like an oxymoron where it can't be so, but I've said it many times that my students, myself and my students, we can be trading the same market, two different directions, and still find profitable trades. Did that explanation, was that helpful to you, at least in that regard? And I'm looking for tweets as a response when I'm asking that. Notice how we reversed up into the low of that fair value gap again. Remember, this range here is a 15-minute fair value gap. That's that gap here, okay? We traded back up into it here. And now I want to see, does it strongly reject that fair value gap and aggressively start moving lower? Or does it power through it? And if it does, then we would look for this fair value gap to act as support. So you have to be really, really nimble and patient in an environment like this. You don't want to go in here trying to force your will on it, impose your will on it, because this doesn't work. Don't tell me you took trades. That's the rule. First rule of Fight Club. You don't talk about Fight Club. If you start telling me you're taking trades, it's going to get in my head, and I'm going to be worrying about what I say next because I don't want you trading. I want you learning how to read price action. That's what my mentorship is. My paid mentorship was how to teach and read, or not how to teach, but how I trade using price action. But the mentorship is how you are trained to read price action. That was the promise. The promise was you're going to learn how to read price action better than anybody else is going to teach you, and you'll understand precision elements that are outside the scope of retail logic. This is no different. You're not paying me, but the same expectation is being held here, that you're not to be trading with this. You don't know what you're doing yet. And you really shouldn't be doing anything with demo either, because you're reading the tape. You're reading what these candlesticks are doing. All right, so I'm looking at dollar. Dollar looks like it wants to come down a little bit. There's a bit of a diagonal trend line on the dollar index, and I don't like that. I don't have any faith in diagonal support and resistance. So that means it could potentially trade down a little bit lower on dollar, which would give some lift to get potentially above that fair value gap here on ES. Let me take a look at the NASDAQ. I want to show you something here. I get questions all the time. How do I add the NASDAQ chart at the bottom of my TradingView chart? You go up to this little plus symbol here. Okay, click on that and type in the symbol that you want to utilize as a compare. And you don't want to do that. I clicked too fast. You want to go to new pane, and it'll plot it underneath it, okay? And then you can keep it on a line chart if you want. In this case, you would look at it with the low, plotting on the low. You can see the divergence between the low here on ES and the low here is lower than that one on ES. We don't have that lower low on NASDAQ. Now, if you don't like the line chart, the best way of doing it really would be just doing the candlesticks and setting your candlesticks up as you would your normal chart. Everybody asks all the time, what's your color scheme? It's no magic between what colors I'm using. Colors don't mean anything. That's what you see in the candlesticks. Or sometimes that's not in the candlestick. So we have, see this divergence here? ES went lower. The NASDAQ failed to go lower. So that's also another contributing factor as to, and I failed to mention, I apologize, but it's hard to read this stuff live and talk about what I'm thinking about at the time and still make the lessons helpful to you. I'm not going to be able to always pull up everything because I'm trying to articulate what it is I'm feeling inside that makes me trust where it's going to go next, why it shouldn't do certain things. And I have to obviously think about what it is I'm expecting to see. Then I have to formulate a way to provide a statement to explain what it is I'm thinking the whole time the market's going on. Like, it's not hindsight. I got to do all this real time. But in a perfect world, obviously, most of you already do this anyway because you've been trained to do so. You want to be referring to the highs and lows comparatively between Dow Jones. The symbol for that would be YM. The symbol for June contract is M, and then 2023. So if you wanted to plot that down here, instead of the NASDAQ symbols here, NQM. M is for June. We were using H, which is the symbol for March. In the third Friday of June, this contract will expire and we will roll over into September. So the symbol for September would be the letter U. Okay, so there's only 4 symbols every year for the futures contract. It's H for March, M for June, U for September, and Z for December. So that way you know your contract rollovers. It's always the third Friday of each month of that contract month that it expires. But I like to roll over when I start either seeing one of two things. If I see the volume explode more in the next month out, which is why I rolled over from the March contract to June, or if open interest, like if I hadn't been trading the market and it's something I want to go back into, trading another market that I hadn't been touching for a while, I'll wait for open interest to be larger in the next month out, and then I would roll over. Rollover is simply taking the present nearby contract, which is still March, but we roll over to the next month. So all trading would be rolled over to the next contract month. All right, so so far we've had if you look at the March contract, just pull this up real quick. Let me finish my thought. I'm sorry. These lows here in ES were not matched. In a symmetrical market, this low here on NASDAQ should have went lower. It didn't. That also builds the case for why it moved from here up into that fair value gap that I mentioned, and we've seen it deliver. Let's take this off now. I want to show you the ES March contract. Okay. And this price is trading at 38.60 and a quarter. So 38.62 essentially. And it's trading in the June contract at 38.94. Okay, so that is a normal carrying charge market. Not that this is like a livestock or a grain market, but even in these indices, if there is an inversion where the nearby contract is more money in terms of its price, whereas it's not being shown that here, it's more higher. It's 38.90 here, whereas in the 38.60s. So it's like a 30-point premium in the June contract. That's normal. But if there's ever a time when the market has a higher price in the nearby contract and it gets cheaper going further out in the future, then we are in a market that is poised to go up strongly. We don't have that here. I'm just tossing that out there as extra, no extra charge. So dollar did in fact go lower, like I mentioned, because diagonal support and resistance sucks. Trend lines are garbage, and I know it's probably going to offend some of you that use them, but trust me, they're subjective, and you can find 50 different ways to put a trend line on the chart, and it's not consistent. Whereas fair value gaps, points of reference where stops, they're not ambiguous. They're there. So far, we've hit that fair value gap here, and we want to watch. If we trade below this low, how we manage to trade at this level here. It can trade down to mean threshold, which is this down close candle's midpoint. I'm using the high to the low. It can touch that with the wick, maybe even go just through it a little bit, but the bodies, if a body trades through that and starts a new candle, to me, that's indicating heaviness. Heaviness is when the market's likely to continue going lower. We don't have that yet. We're still inside of a small range, which is exactly what we were expecting anyway, because why? We had that big movement overnight. All the excitement, all the movement was overnight. So now everybody's arm wrestling, trying to figure out what it's going to do next. And this is where people get chopped up, you get beat up, you get frustrated because it's not moving the way you want it to move. You want to see a big move go one way or the other. You don't care. You just want to see movement as a trader. But you have to know when to anticipate these problematic periods where the market's going to be very fickle. Fickle is like, it doesn't want to do anything. It's just going to say, nah, I ain't going to do nothing for you. And it'll frustrate you because you want to trade. You want to see your targets hit. You took off for work, or you stayed up to watch this because there's a live stream going on. But you need to know when I'm not doing this anymore, I'm not teaching anymore, you're going to know these rules and these procedures and protocols. You will lean on them because you've seen the effects of following them is beneficial. You're not surprised when the market goes into chop. We can predict when that's going to occur. That's not a problem, okay? We also can predict when there's going to be big movements. That's easy too. The hard part is for me as an educator is to teach you, number one, be patient going through these lessons because you don't understand how much you're learning right now. You really don't. But you're going to understand months from now how impactful knowing when to anticipate consolidations, choppiness, because that's going to do what? That's going to help you stick to rule number one, which is preserve capital. Your job as a trader is not to make money first. Your job is to keep the money you have. Everybody else does an efficient job of blowing out. If you believe the statistics, and I believe them, 90% of the people that trade with real money, they're going to lose their account expediently because they don't have these skill sets. They don't have patience, number one. And if they do have a losing trade, which all of us do, all of us have drawdown, all of us have series of losing trades and getting it wrong and missing trades. You're going to have that. But the retail trader, and 99.999% of every educator out there does not teach when not to trade. And I have been a big proponent of that because that's where I got beat up. When the markets are moving, I have tools that could get me in there in stunning fashion and hold for amazing point or pip hauls. But when I was new, I didn't know how to avoid specific times of the market or conditions. Just because we're in a kill zone, okay? We're in a kill zone and there was a high impact news event. Oh, great, wonderful. That doesn't mean it's going to move. Why? How did I outline that for you today? All the movement was overnight. It's one-sided. And when we open up, they utilized that news event this morning at 8:30. Was it impactful? It moved around a little bit. It moved down, created the lower low here, then that low. And then retail's doing what? Think about what they do typically. 90% of retail traders are doing some kind of breakout strategy. They want to have some kind of confirmation, they think, that if it goes through a level or if it moves above a certain level, they want to be long. Or if it goes below a level, they want to be short. They think that once a move starts happening, they want to maintain a position on the basis of momentum. And that's exactly what I'm teaching my students and you listening, how to capitalize on that, because that logic is flawed. It can work. Like you can use breakout strategies with my concepts that teach you, like if you know how to trade the right direction in the right time, you can use a breakout strategy and it'll work for you. In fact, if you go through the core content, I'm actually teaching you how to sell short on weakness and buy on strength. I don't like those entry styles, but you're going to find that if you're going to be a higher time frame trader, that's usually going to be the mechanism that you're going to use to get into the trade, because you don't have the benefit most times if you're running a business or you're in school or if you're working. You can't trade these lower intraday time frames. You're going to be utilizing that entry strategy where the market puts you in, but you'll be focusing on a time when the market's predisposed to move in a great, magnificent manner, higher or lower, not just simply, it moves a little bit. No, you want to have a higher time frame trade that's going to be moving for weeks, not just a day. So in this respect, we're looking at the sell side here that was this morning. Oops, that did not go where I wanted it. Bottom left. And okay, so now think about what was going on overnight. Market just kept going lower. Made a short-term low here at 650. 8:30 news, we drop down. The first 15 minutes, it does what? It goes below that low. Think about what retail traders would see here. This is a bear flag to them. It drops down below a low. Retail traders that want to sell short on a breakout, they're short right there. Where's their stop loss going to be? Above here. That's a lot of movement. Oh, maybe. Maybe not. Maybe they're trading a micro. Maybe they're trading with options, something to that effect. The logic is above this high, that's a trigger for they don't want to be short anymore. So what's going to happen? It's going to trick them in going short. Those sell stops that trigger in misinformed traders, street money, dumb money, not smart money, they're short here. Who was taking and who would take the other side of that trade? Smart money. Aiming for what? The fair value gap I outlined for you this morning. And it would be above this high where the buy stops would be resting. And this is where they would mitigate any positions that were long. They could get those off here. We haven't really seen any indication that that is in fact the case, because we're still inside this small little range, which is what? The type of environment that I told you at the beginning of this live stream, that's what we're expecting. And I didn't say it just today. That's in the rules that's in my YouTube channel and all the lectures. After big candles, big daily candles, big movements, big days, okay, in this case here, we had one-sidedness overnight in London. Huge one-sidedness. You have to be very, very careful not to go in expecting it's just going to keep going lower. Now, in my 30 years of experience, I've probably seen maybe 2 or 3 times it's done something like that. But if you're trying to get short, and I'm not suggesting that you should be, but I'm saying if you are trying to be short, you have to wait. You have to wait until it trades to a premium. If you are not doing that, you are absolutely gambling and you're chasing price. That's the definition of it. You're chasing price. You're thinking like a retail trader, like it did here. When it traded lower, they want to be selling short about below that low. It's already went significantly lower from overnight with no real runs on liquidity prior to this one here. There's been no stop runs here at all. It's all been displacement lower, rebalance, trade lower, or leaving fair value gap. The sell side here has been taken, putting retail traders short. The logic is smart money would buy those sell stops. As they want to get short as a retail trader, they want to try to break out to the downside because they think the banks are collapsing and it's Armageddon. It's going to keep this going straight down. The algorithm is going to do this. It's going to give that to them, allowing smart money to do what? They can buy that. Ride it up to the buy stops here and the fair value gap that I've outlined this morning. So smart money buys retail sell stops and sells to the buy stops above here. in this level. Because not everybody's going to put a stop loss right here. Who's going to put a stop loss up here? Large funds, investment banks, larger traders that want to be trend following. They have more money than you folks. They can withstand a little bit more of a price movement than you are. You see two handles movement against you and you're freaking out. That's the difference. Okay, there's a difference in the food chain here. The difference between what I'm teaching you and what you learn anywhere else is that we're not looking at patterns. We're looking at the context and the logic as to why price should go where it's going. And if you can't outline with a great deal of confidence what you're expected to see in price action, why that would be even reasonable to anticipate, and if you can't see a storyline behind why the market would do specific things and how it could take out less informed money, why it would be advantageous for that to happen, because if the algorithm is going to run from this low up to here, that movement offers opportunity. It's doing two things. Number one, it's allowing efficiency to this imbalance here. It's offering efficiency in terms of providing more liquidity for sellers at a higher price with these buy stops above this high being taken out. Because there's a buyer and seller at every transaction. So what we're doing is I'm teaching you, which is what I refer to as my market efficiency paradigm. The market is efficiently delivering price most times. There are times when it delivers inefficiently. Inefficiencies like fair value gaps, wicks, those inefficiencies will be revisited. Maybe not immediately, but they will be revisited. So we look at how the less informed traders that use retail concepts and logic, breakout strategies, trend lines, harmonics, Elliott wave, that type of thing, all those gimmicks, I'm just going to be honest, that's what they are. They have no bearing on what makes the market go up and down. The market's going to go to one of two things. It's going to go to an inefficiency, or it's going to go to liquidity in the form of stops, be it buy stops or sell stops. That's the only two things it will do. If it's not doing that, it's going to go sideways. Now, think about what I just explained. I've said this before, but there's so many people that are watching my videos because there's a lot of them. And if you're new, the question usually is where do I start? Start with the 2022 mentorship. It's 40-some videos. It'll get you right into the marketplace looking for a specific setup. That way you can back test it, study it, look into old examples of it, and you'll be quickly convinced that there's something that you can see repeating week after week. When you have time, if you want to go through all the other stuff on the videos, do it. Who cares? I don't care. But I'm teaching this live to you, and you really want to be in these live sessions, or at least watching them as soon as you can get your hands on them, because this is the teaching. Okay, this is the part that makes it realistic to you. Because I can talk about things in a chart that's pre-recorded, and you're going to think like some of the trolls, oh, it's cherry-picked. You form-fitted that. But I don't do that when I'm on Twitter and I'm doing it here. I'm outlining it live. I don't have a safety net. I'm either right or I'm wrong. And I have a track record. Look how many times I'm doing it right. That's the track record, okay? I don't need to open up my books to you. I don't need to do that. I'm telling you what the market's going to do beforehand. If I didn't have an audience this long, it would be apparent that I don't know what I'm talking about. There is no algorithm. There's no way to time the marketplace, and there's no reasonable way of discerning what price is going to do next. Then it would be what? Random. And these markets are not random. That's what I'm trying to communicate to you. Can I take you in front of hardline proof that here is the algorithm? Here it is. I can't do that. I can show you in the chart using the logic that, in my mind, should convince anyone with reasonable common sense that there's not a buying and selling effect going on here. But that's what we're told. We're told that as traders. We read books, we listen to other traders. They make money using whatever they're doing. There's people that make money with Elliott Wave. I'm not saying they don't. I'm not saying that there aren't people out there making money with harmonic patterns. They do. But that's not what makes markets go up and down. That's not. And it's not buying and selling pressure. It doesn't matter. If the market's going to collapse or go parabolically higher, it doesn't matter how many people's buying it. It's going there. Think about it when you look at a Forex pair. If a central bank comes out and says, their currency's overvalued, they're going to reprice it lower. Who's stopping them? The buyers are going to keep it from going down? No. When the euro and the Swissy were depegged, did the buying and selling pressure have any effect there? No. It was a massive destruction. Gone. Brokerages were closed down. When markets go into limit up, if you're looking at commodities, like say you're trading a grain market or something like that, and the market goes limit up or limit down, how many contracts were traded when that happened? Oh, never thought about it like that, did you? Right. And that's the things that I started thinking about. Like, wait a minute. All this attention on volume. Volume is not the answer. That is not the answer, folks. So market profile, another gimmick. Yes, people make money with it because you can make money flipping a quarter too. All you need is a catalyst to do something. People make money at casinos too. Most don't, but some do. Some people win the lottery. Some people buy scratch-offs and win. The likelihood is low. But sometimes that happens. But if we put 1,000 traders in a room learning Elliott Wave, you're not getting 1,000 profitable traders. You're not. And that in itself should cancel any idea that, hey, this is the be-all, end-all. What I'm teaching you is the market. We're not a cult. We're not a team, okay? And you don't have to like me. But what I'm teaching you is the actual market. So don't come here to try to be my worshiper. I don't want to be worshipped. I don't want to be anybody thinking of me like I'm a hero. I'm not. If you're on the other side of my trade, I don't feel sorry for you. So I want you to understand that. That's the person that you're looking up to. I have no compassion for you. If you made the mistake of taking the other side of my trade, I do not care if you lost money. I'm teaching you so that way you don't fall victim to that. There's a way of doing this without all of the mumbo jumbo gimmicks. Again, in case you missed it and you have your journal ready, these are the only two things that you need to worry about. Is the market likely to move in an expansion, higher or lower? If the market's not predisposed to do that, then it's doing what? It's going to consolidate. Should you trade in consolidations? No. You've seen me outline certain things in this small little consolidation, but I'm not going to lose my mind worrying about these small little tiny micro fluctuations. It's not worth it to me. I wouldn't be doing anything this morning, but I'm showing you how you need to prepare. So that way when we're not together in the future, when I'm not doing live streams and such, you'll have this information in your journal. You'll have this video to refer back to. So the market's either going to consolidate or expand. Now, if it's going to consolidate, when does that usually occur? After big moves, because large ranges beget small ranges, and small ranges beget large ranges. So small moves bring in the likelihood of a big move eventually. When can the big move happen? Your economic calendar. Just like the TV guide, okay? When you go on your cable TV, you want to see when the next sports team that you follow is going to play. Go to ESPN. When's the Knicks playing? When's the Heat playing? When's the Ravens? The Yankees, or whatever. You can pull up and see, okay, this channel, at this time, this is when that program's coming on. Well, the markets are programmed, folks. They're scripted. Whether you like it or not, they're scripted. And these movements are timed. And you're looking at the volume thinking, that's the reason why. No, it's not. That's when everybody is being induced into taking or getting removed from the marketplace, because the market's moving regardless of how many buying and selling is going on. That's the big con. That's the scam that everybody buys into when they first start trading. And it's uncomfortable to suggest that it would be completely controlled, but why should it be? Why should you wrestle with that? I don't think anybody should wrestle with the idea of it. You should be thankful that they're 100% manipulated, because that means that your currency, that these stock markets can't be influenced by some kind of terrorist act where, oh, they come in and they did heavy selling. Saudi Arabia, they're rich. They have a lot of money. America has a lot of enemies. You don't think that China and Russia, Iran, they all could come together and short the markets and kill our entire stock market? They could. If that's what you believe, buying and selling pressure could happen and cause these markets to do that, why hasn't that ever happened? Because it can't happen. That's not going to happen. Now, eventually, I'm sure somebody's going to, see a big stock market crash, and somebody's going to get faulted for it. And they may even use a narrative, something like that put us into some kind of a WAR, you paying attention. But it's just nonsense to believe that these markets are left open to any kind of potential for that to occur. I don't lose sleep over the market being muscled by people like that. These markets are controlled. Now, just like a casino. You can have a card counter come in once or twice. You run the tables and you game them for a little while. But most people aren't card counters. They're not professional gamblers in that respect. But they have a house edge. These markets have a house edge too. And just like the wrestling that you used to watch and I used to watch, and it's still on TV now, the outcome is predetermined. And I'm sorry, I don't care where you work, I don't care how long you've been doing it, but that's how I do this. I know what these scripts are. I'm telling you where they're going to go and why it's happening. If it wasn't like that, I wouldn't be this consistent. I wouldn't be telling you on Twitter, in live streams, when it's happening, minute by minute, candle by candle, telling you exactly where it's going to go to next. There's never been any other approach to trading in retail that delivers this measure of precision, this consistently every single day. And that's not a brag. It's not a brag. It's just simple logic. Are you paying attention? Are you paying attention to the fact that these things repeat over and over and over again? Because that should give you comfort, knowing that just like your boring job that you go to, you can't wait to escape, you can turn this hobby into that eventually if you put the time into it. And going back to that equation where it's one of two things. It's either going to consolidate. When's it going to consolidate, Michael? Ahead of a major rate announcement, ahead of FOMC, expect what? Consolidation. Big money's not going to position in front of something like that. In front of a CPI number. Okay, something like that. Or after a large move, the next session, the morning session, there it is. They're going to use the sentiment idea that the smart money sits on their hands and waits for the retail crowd to go in and chase what's already been going on overnight, like we have here. Is the market going anywhere right now? Sideways. It's exactly out of the rules that I've given you on my YouTube channel. I taught those rules in my mentorship in 2016. They're in videos that haven't been edited. I taught this in 1996. These very rules. They have been with me since then. You have to understand that there is a rule of engagement. When do we engage? When do we anticipate certain things? Well, if it's not going to be those instances there, and then we have a medium or high impact news driver, how do we know that? The economic calendar. They're not hiding it from you. That's the wonderful thing. They're not hiding that from you. They're telling you, this is when we're going to release data to the public. That data has absolutely no bearing on the marketplace. It's just a smokescreen. When it doesn't favor the outcome, matching what the report suggests, then they'll say, well, it was already baked into the price. It's already priced in. And then when it does cause a movement that would be justified in the expectations of why that market report came out, and the market does a specific thing that should be expected to do it. In other words, if the report is bearish and the market tanks, oh, well, there you go. That's the reason why the market went down. That's not why it did. But they condition you. It's called priming. Priming. Giving you something to expect over and over again 2, 3, 4 times is enough for most humans. Okay, well, it's going to be the same thing next time. And then you're trapped. So the economic calendar, you need to know what that is going to be providing you. And you can look at it weeks in advance, months in advance. When is the CPI number in April? How about in May? How about in December? All that stuff's scheduled. Just like your favorite sports. Used to be when I grew up, it was Monday Night Football. I can't stand football. But everybody would be watching football at Monday nights. You plan when you're going to engage. These high impact news drivers, if we don't have a move, like it's a large range move, or we have an overnight move like this, and we have a medium or high impact news driver, then we are likely to do what? Have a low resistance liquidity run. Oh, you went and said it. That's what I'm teaching you to look for. This is a high resistance liquidity run signature. Meaning that, yes, I can see where it's going and I can outline it and you can see it happening. But number one, it's not a lot of movement. Two, it's very, very frustrating waiting for it to happen. Like I'd rather wash my cars. Wash my cars. I had somebody tell me, there's no R in wash. Listen, I was raised by Virginians, okay? And this is the way I was taught, okay? I know there's no R there, but I'd rather wash my car. I would rather cut the grass than do anything with this today. But I am teaching you how to anticipate this. So that way you can see there is logic. You can predict when the market's not going to do something. So therefore you can do what? Not trade. Don't even open your charts up. Have a life. Do something else. And then you can also know by having these instances understood, if it's not under these conditions, what are we looking for then? We are looking for medium or high impact news drivers to provide a smokescreen to trip up less informed traders to be our liquidity in low resistance liquidity runs where the market just goes and just easy, salad days, easy trading. That's what that means. Easy, easy, easy. But every day is not a low resistance liquidity run. So the equation is this. Is the market that you're sitting down in front of likely to consolidate? How do we know it's going to consolidate? I've already mentioned those rules here. Go back. I'm not going to repeat it here. If it doesn't meet that criteria that it's likely to consolidate, then we are looking for medium or high impact news drivers to offer a smokescreen and then a low resistance liquidity run. That means a nice easy run to liquidity or inefficiency. So now we have in the next equation, are we buying or selling? Where's the market been? Where is it drawing to on the weekly and daily chart? Where's the stops that have not been tapped yet? Where's the inefficiency opposed to the most recent price direction? Well, go back to this example here. We went down overnight. It's likely to consolidate, but more specifically, we know that the retail traders are going to do what? They're going to chase it going short. They trap them here, take them up to the inefficiency and buy stops. 2 birds, 1 stone. Then enter what? Consolidation. Buying here, buying on the order block, into that area here. There's your 2 trades for today. SMT diversions, the NASDAQ failed to make that lower low here. That qualified the likelihood of getting up into that range. I mean, just look at where we're at here. I told you we can go down the middle of that order block there, mean threshold. That in itself, selling short here, target, consequent correction of the wick, order block, mean threshold of order block. There you go, boom. That's 30 handles or so. In a rough market, it's chop. I outlined it, showed it to you. I'm not interested in trading it. Am I saying that you shouldn't? No. You might see this and say, you know what? I'm not afraid of this. This makes perfect sense to me. I'm going to trade in these types of markets. I'm going to trade in consolidations because I won't have my face torn off with a big run that came out of nowhere because I don't know how to see that yet. And then over time, you'll learn how to do that other approach to trading, which is where I think the better strategies are. when you are trading with expansions, where the market just quickly gives you what you're looking for and you can be done and go about your business. I don't want to be in markets like this where it's really just, it's daunting to watch this. It's like watching paint dry. So the equation is consolidation or expansion. Okay, if it's going to be expansion, is it bullish or bearish? That goes back to the weekly chart. Is it likely to expand up or down on the weekly chart? We're not trying to predict a closing price. We're just likely to see more movement up or more movement down based on the weekly chart. The next candle for the weekly, is it more likely that it's going to make a move higher or lower? Where's it going to go to? Is there stops it needs to go to in efficiency? In that logic, we use that through the entirety of the week. Specifically, Monday, Tuesday, Wednesday. We're looking for the setup by then. Now, if we're bearish, because we expect the weekly chart to expand lower, we go in looking for discount arrays. Anything below market price, what's market price? Where it's trading right now when you sit down in front of your charts. Where's the inefficiencies below that? That would be in line with the expansion lower on the weekly chart. So we're in a sell program. We're looking for shorts. But we have to know what it's aiming for. Where's the sell stops? Is there any fair value gap below market price? Does that range offer opportunity for you to get at least 5 handles or 10 handles you can use as a filter? If it can move 10 handles, chances are you probably have a really good opportunity to get 5 handles painlessly. If you know it can move 10 and you're only trying to get 5, that's very forgiving. You can be a little off on your entry and you can be a little off on your exit and still get the meat on the bone. Dollar is ripping higher, trading above its relative equal highs formed at 9:30 and 10. If you're looking on a 1-minute chart, that's going to offer some heaviness on ES. So since we're at the mean threshold here of that order block, remember I was saying if we have a body that closes below that, that's going to offer what, to me, I would interpret that as heaviness. And then we'll be revisiting this low here because sell side now exists here. Okay. Give me 1 second. So we have one of two things happening here. If we cancel out the idea that the market's in consolidation, it's going to expand. Is it expanding lower or higher? You determine it from the weekly chart. What are you doing on a weekly chart? What I've outlined here on this 5-minute chart. Where it should gravitate to. All these levels I've outlined, I told you beforehand, and it's going to them. That's the same thing you're doing with a weekly chart. Is it like, see, what you're fearful of is you don't have time or experience watching price action. See, I'm taking you into the charts, looking at this stuff. When it's boring, these are the times that you need to be learning because this is where you're going to lose money. Everybody can make money in big moves. If you're on side and a big move comes, everybody gets lucky, and that's what everybody shows on their social media accounts. You see it that way. But most times, a lot of traders don't have an idea what it is they're doing or how to filter out potentially losing days. And you got a lot of people out there that will say terrible things about me and say I'm cherry picking. I'm putting things on Twitter that I don't delete. It's a track record that's ongoing. In my private mentorship, in the commentaries, which I don't upload and I won't upload them, I was doing what you see me doing on Twitter daily, 90% accurate. And if I'm not telling the truth, my mentorship students can come into a comment section and say I'm a liar. Go right on to Twitter and say I'm a liar. There should be thousands of people saying I'm a liar. You won't see that. You're going to see people saying, no, he's telling the truth. I was there. I'm one of them. I've seen it just like you're seeing it right now. But you have to determine whether you're going to be submissive to the process that's required. You're going to have to put a lot of time into this. And you have to do exercises like I'm putting you through right now. And so I guarantee you, most of you have probably started this video, turned it off. You're like, no, this guy ain't telling me anything. And you're going to fail. You have to know this part. And nobody writes books about this kind of stuff. Nobody sells courses about this stuff because nobody would pay And that's why they fail. That's why they fail. You want to know where you're going to mess up. Wouldn't that make sense? Wouldn't that make sense in anything else? If you're going to pay money, invest time and energy into something, what could go wrong? Where will I hurt myself? Think about it. If you joined a gym and you paid for a personal trainer, one of the things they're going to tell you to do is do it this way so you don't do what? Hurt yourself. Lift with your knees and legs. Don't lift with your back. It's always in everything we do, but when we come to trading, it's got to be something different. The guy or the gal that's teaching me, they got to teach me the way I want to be taught. I know how I should be taught. I know how I should learn this. Then you already know. Don't come to me. Don't come to anybody else. You know. You're the teacher. But if you discern whether or not the market's going to expand or in consolidation, if it's not consolidation, you go to the weekly chart. Is it going to expand higher or lower? If it's expanding higher and you're bullish, you're in a buy program. That means you're going to be looking for inefficiencies, fair value gaps, SIBIs, above market price, or buy stops. If you're looking at the weekly chart and you think that the weekly candle is going to expand lower, you are in a sell program. That means you're going to be looking for inefficiencies, fair value gaps, BISIs, below market price, or sell stops. Now, folks, listen, please listen. How complicated is that? It does not take acrobatics to accomplish a simple process of saying, okay, we talked about how does the market consolidate. When does the market consolidate? What do we use the economic calendar for? When are these trades going to form? It's all programmed. It's all scripted. Your work, the requirement that's required for you to do this is you have to sit and study old moves. You have to do that. You have to do it and enjoy doing it. Because you're going to do that the rest of your life as a trader. You want money. You want to make money. You want to profit. That will not happen consistently without you doing these types of things, because this is what leads to that. You have to know where everybody else loses, you avoid that. I'll say it again. Where everyone else fails, you are sitting still. Everybody's in this stuff right now. Maybe live streaming. They're in here trying to trade all kinds of stuff. They see something in the chart. That's a religion. It's a Rorschach. You see whatever you want it to be showing you. It's a simple process. Simple. Think about what I taught in the 2022 model. And there's 40 videos from last year. It's on my YouTube channel. If you're new, and it's the first time you watch the video from me, how should you begin trading? Well, you don't start with the live funds, and you don't even go into a demo account. You study price action. That's what mentorship is with me. I teach how to read price. I do not teach you how to jump into a live account. I do not teach you to go out there and trade with these live fund accounts. Okay, I'm interviewing students that have done that. But in my mentorship, I've never said, go out there and trade with real money. I always talk you out of it. I don't want you to do it, because most of the time when you think you're ready, you probably aren't. You're probably impulsive. You're in a hurry to start making money because you're broke, you need more money, you need a secondary income, or you just can't wait to have the action. But you have to have, at some point you got to listen to some voice of reason. Someone that's been here before. I've hurt myself, financially hurt myself, emotionally and psychologically and physically hurt myself in these markets, doing the things that you're trying to do right now and thinking that you're going to be exempt. You won't be exempt. There's a way to do this properly, painlessly, and without losing money. You have to do it by going through old data, studying it, getting a feel for what is a low resistance liquidity run signature. What does it look like when the market created these high impact news drivers? Because you can go back and look at old calendars. You can see where the old reports were. and study what did they do. That's my back testing. My back testing is not going into a Forex tester or a futures tester and playing like in market replay. That to me, that's a walk forward. That's a walk forward test of a model without using real-time data. My back testing, the way I teach my students, is you go through old data and you find the patterns that I'm teaching you that price will follow. They're not retail patterns. I'm teaching you how to discern the narrative, why price does certain things, when it will do it, how it will do it. All the questions that I get asked most times are all answered by you simply sitting in your charts. But see, the problem is this. You are afraid. You're afraid that you're going to put time into this. Half-assed. You're going to think and defend it and say, oh, no, I did it. I watched all your videos and I scribbled some things on a notepad. But you did not go through and study old price data, study how much time it took for the price to move, how much drawdown did it take, how much time did it require before it moved into your first partial. And then you conditioned yourself by seeing example after example after example of that. When you do that, and you have a long log of examples, of case studies, you will know what you're looking for because it'll make sense to you. It will leap off at the chart. You'll know exactly what PD array, if it's a breaker that you like, if it's an order block, a fair value gap, institutional order flow entry drill, optimal trade entry, turtle soup, implied fair value gap, where your trade setups form. Are you going to trade away from a new week opening gap when you're bearish to the next lower new fair value gap? Is that going to be your criteria for looking for your setups? Some of you might not want to do that. Most of you probably would love to do that now because you've seen the power and the effectiveness of that pattern of, not pattern, but that concept of using those specific 3 levels. I don't tell you how you should trade. I give you the tools. I teach you the logic on how to read price action. And you find your perfect model for you. And once you find it, you don't tinker with it. You don't mess around with it. You don't try to make it more fancy or more complicated. You don't do that. You don't try to add other things that I've taught. If it doesn't require it, don't even refer to it. Consolidation or expansion. Consolidation, we do nothing. Expansion, is it bullish or bearish? If it's bullish, what fair value gap or inefficiency above price, or where are the buy stops? That's the draw on liquidity. If you're bearish, you're in a sell program, you're looking for inefficiency below price, BISI, or sell side liquidity. That's it. That's what you're targeting that. That's how the market's going to move. That's it. There's nothing else that's going to happen. There's absolutely nothing going to happen outside of those conditions. Period. End of story. That's the way it is. That's the gospel. Now, how do you trade it? That gets to what PD array you like. Can you see an order block? Do you see the fair value gap? If you're bullish, say your expansion is on the weekly chart, you think it's going to go higher. Whatever market it is you're looking at, because it's not just ES, it's every asset class. But if you think it's going to go higher, you have a draw on liquidity. That means some fair value gap above price or old high or highs where buy stops are going to be resting. That's the draw on liquidity. You think you're submitting yourself to the idea that the market's going to gravitate up there. Why? Because the market goes to inefficiencies for the purpose of providing efficiency, or it's going to go to liquidity. Orders that are hardline in the market sitting there resting above old highs. What's above old highs? Buy stops. So what you're looking for is from that point at time when you're expecting prices to go up there if you're bullish, you want to see something as a discount that to buy off of. A down closed candle that has a fair value gap, boom, there you go. That's a high probability bullish order block. If you see that during a time window when I'm teaching, that this is where the algorithm will start spooling. See, It's not the buying and selling pressure. It's the requires immediate feedback, always working in your favor. You can't take a losing trade. You can't accept the fact that you've done something incorrectly, or your learning curve is a lot more demanding than someone else. You cannot cry and say, just stuff doesn't work. And then say, well, there's no algorithm because I can't make it work. When you now see there's people all around the world making real money. And I told you, I have students that are absolutely killing it. And I'm honestly telling you many times that not all of my students do well. Nobody has a 100% strike rate in teaching everything. There's going to be people that come into this lazily and they will defend it vehemently. Oh, I wrote in a journal. I watched all your videos, ICT. I watched them. But what did you do with it? You can pay for cable TV and get the Food Network and have the favorite Gordon Ramsay program on there, and they could walk you through step by step. This is the recipe to make this. Look, I'm above average intelligence, I think. But I know enough to know, even because I'm watching that, I may have all the ingredients. My oven may be set properly. My result is not going to be the same thing as Gordon Ramsay. Okay, just because I'm watching, just because I paid for the cable television, just because I sat down and I wrote down the recipe and I recorded it and I go try to follow everything step by step, I know enough that I am not going to get a Gordon Ramsay result simply because I watched and I scribbled some things down and I paid my price to observe it. It's going to require me doing what? Doing that same recipe, same process, over and over and over again. Not every oven's going to cook the same way. I've discovered that in our new home. This is a home that has propane. I've never had propane before. There's always been natural gas. And it cooks differently. The stovetop cooks differently and the oven cooks differently. And to be honest with you, I miss natural gas. But learning this is no different. And weak-minded, half-assed wannabes that come here and they try to learn and they can't do it and they cry foul. Oh, this doesn't work. It's a fraud. It's a scam. No, you're a failure. You are failing you. How is it that everyone else, even the ones that didn't even pay me, are using the logic that I'm teaching on this YouTube channel, and they're getting funded, they're making money, they're making ends meet, they're seeing progress, and they see precision. And many of them are actually taking the same things I'm recording my executions on. And they say, oh, look, here's the same trade. I took that same trade. Here it is. I'm not telling you where I'm getting in. I'm giving you the logic of where the market's going to go. And my students know how to read between the lines. Oh, we're aiming here? Okay, so we're in expansion. We're in a buy program. We're going to be looking for a premium array. It means there's some kind of SIBI or a fair value gap or buy side liquidity we're going to aim for. Oh, that's easy. So what do we want to do to get into it? Oh, we'll just buy a fair value gap. We'll buy a bullish breaker. Oh. Suddenly it starts to make a lot more sense. You mean to tell me I don't need to put all those things in those 1,500 plus videos into every one of my trades? No, I don't. But those videos are teaching you how to be independently thinking about how your model is going to serve you. And you have to be willing to put in that time. And I'm sorry, but some of you don't have the patience to give yourself the required time. And that's unfortunate. That's impatience. That's a lack of discipline. And frankly, laziness. Oh, you can't call me lazy. I just did. And if I was standing in front of you, I'd say it to your face. That's exactly what it is. I've seen it so many times. The ones that really vehemently try to defend, oh, I've done it, I did this, I did that. They are the worst in terms of what they've done. The most laziest ones. And they never provide evidence, the proof, the time they put into it and what they did. Show me what you were doing. They won't do that. Because believe me, if you were doing all the work I teach you to do, you have logs of case studies that you studied. And bottom line is The failures here, like everywhere else, are the ones that do not put in the work. You're just lazy. You wanted lottery wins, easy money, every trade win. Nope, it doesn't exist. Look at the bodies of the candles at the mean threshold of that order block. Is that random? Think about what I said. Did we close with a body below that mean threshold? Nope. And if it did that, what would it mean? It would be heaviness, meaning that we would revert back to this sell side liquidity. Because the bodies didn't do what? What the engineer said needs to happen. What did price do after that? Oh, 20 handles higher. Where do we look at now? You extend your fair value gap over, and you identify the high here with buy side. But where's the entry? You have to read price for weeks and months before you even consider taking trades. That's the part that you don't understand. You're trying to rush in there to do something. It won't make any sense to me unless I'm trading with live funds. Okay, go fail. Go fail, call me a fraud, and go trade something else. I don't care. I don't have time for you. The people that are going to be learning how to do this, listen, you're meeting people that are making significant annual salaries that people in professions make. They're not doing a whole year of trading to get these types of results. Like that's not typical. I can't say that you're going to get that. I can't promise that. But doesn't it at least inspire your curiosity to do it the right way? If I'm telling you, I'm here. I've already said it multiple times. I guarantee you this. Listen, okay? Get your soundbite recordings ready and all that business. Inner Circle Trader Michael Joe Huddleston guarantees you will be able to read price better than you would ever learn from anyone using any other methodology, course, gimmick, tool, indicator, anything. You will not find anything more precise than this. I'm out here in social media waiting for somebody else to come out here and do anything better than I'm showing you. I'm showing you to the tick precision daily. Crickets and failed live streams. That's what you're seeing. A lot of talk, but ain't nobody bringing anything better than this. You need to put the work in and fall in love with it. It's a lifestyle. You cannot be listening to Mickey Mouse mentors out there telling you that this isn't going to work for you. Because if you listen to that and you take that in, you'll believe it. And you'll never do the work to show you, the person that's most important, that you can. I don't need to be out here on Twitter. I don't need to be here doing live streams. I don't need to teach. I don't need to be doing this. I know it works. My students know it works. And you're seeing people with real receipts. The companies themselves that they're getting paid through. Because they can say, oh, he's faking his broker statements. You think these funded accounts are going to do these mock-ups where they're interviewing people where they paid out money? You think they're going to script that? Think about it. At first, I'll be honest with you, I didn't like any of this funded account stuff. I didn't like it. But it makes a perfect argument to anyone that's out there saying, oh, they photoshopped their results. And you're still seeing people saying, oh, it's fake. These companies that other people are trading with and getting withdrawals from, they're interviewing these students of mine. I'm not just taking their word for it. I'm seeing their receipts. They're being interviewed by the very companies that gave them the money. Pray tell, how on earth is that fake? How's that gamed? Huh? See, I told you this year, I'm canceling all of your excuses. I've had profitable students since the 90s, folks. I can make traders make money. I can do that. I can do that for you, but you have to do all these things. And if you don't do it, you will fail. You will fail. And you're going to take that same logic into some Mickey Mouse operation somewhere else outside of me, and you'll try their garbage, and you'll fail there, and you'll be like the cynics out there in the world. Oh, everybody loses money trading. It's a game that nobody can win. Nobody can time the market. And you're a statistic. That's what you are. And I'm trying to prevent you from becoming a statistic. All you have to do is pay attention, show up every day. Cost you nothing. But you're getting a PhD. I don't know. Maybe I'm just an old fuddy-duddy. I just like things to be blunt. And sometimes that comes across as rude or arrogant. And that's not my aim. Believe me, I can be arrogant. I could do a lot of things that would be very arrogant. And I could show off. That's not what I want to be. I don't want to be that. But I do want to be a voice of reason, and I do want to kick you in the ass when you need it. Like, you need to be shook up sometimes. Sometimes you do things lazily. Sometimes you shouldn't be in here pushing a button, just trying to see what's going to happen. Think about why you're doing that. Why are you pushing that button? If there isn't anything in your model saying that you should be entering, what are you really compensating for? You're bored? Someone hurt your feelings? You want to flex on somebody that says SMC, ICT concepts are a fraud, ICT is a fraud. You want to go on social media and show, look at this trade I did. That's all the wrong reasons. Either your model's in price or it's not. If it's not, you do nothing. If it goes past the time of our trade windows, where we like to look at where price formations, you produce these setups, then you do what? You turn your charts off. Go do something else. As long as the sun rises tomorrow, and as long as these markets are here, opportunity will be here. It will be here, okay? I promise you it will be here. Don't be afraid, okay? Don't be afraid that it's going to take you a couple months or the rest of this year to learn this. But ICT, your Twitter scared the shit out of me. You're telling me that it's Teotihuacan, the end of the world as we know it. Well, that's always a given. And then the sun could go into a supernova and there it is, we're done. Is it likely to happen? Probably not. But if you're going to live your life like that, good grief, just crawl under your bed and just wait to die then. But you have to at least take the initiative and do all the things I'm telling you to do. And yes, it's hard. It's hard, absolutely hard, because you're conditioning yourself to do something 90% of everyone else fail at. And you know that statistic coming in. What are they failing? They're failing to find something that matches their personality. They're failing to understand what makes markets go up and down. And they're failing to have sound risk management. Those three things. If you just simply applied that to anything trading, flip a quarter, you could be profitable doing that. It sounds impossible, but it's true. So we've already tapped the bottom or the low of that blue fair value gap. We've done that here. We rallied down to the main threshold of the order block that I outlined. I said that we have to see a close. If we close below that, and that would indicate what? Heaviness. The body's respected that. Now we're back up here. Why should it be returning here? What's in this area over here that would be useful? If we didn't have these wicks, now this is important too. This, you want to actually screenshot this before I start saying anything. Screenshot this actual portion of price action right now. I'll give you a second to do it. If this singular candle here with the wick that touches the fair value gap, if that was the only wick here, and we didn't have this one and this one and this one, I would look at that wick and run consequent encroachment on that. And if it hit that, then I would expect it to just gravitate back lower and just be in this range longer. But because we have all of these wicks, that consequent encroachment to me It's already been utilized multiple times. Here, and now we're into it here again, and here again. It's not of interest to me. Can it be referred to later on? Yes, I would like to see it. If we go higher, I want to see it act as support. I don't want to see bodies trade down below that. If we go higher, I don't want to see it close below the consequent encroachment of that wick. Meaning that I favor a run into that fair value gap once more. And more specifically, the next level is that rejection block, which is the up close price on that candle here, the green one. So that level, that's the rejection block. Okay, I would want to see it trade up to that and watch it trade through it. And then if it comes back down, I want to see this fair value gap act as support. Now, is that difficult? No. You just aren't familiar with seeing that like I have for 3 decades. Once you see these things repeat over and over and over again, you're conditioned to anticipate specific things. Is there a breaker in here? No. So why are you worrying about a breaker? It's not there. Do you see a volume imbalance in here? No. So why are you worried about a volume imbalance? You only are looking for what the price itself is showing you. That's all. That's all you're doing. I've given you very specific PD arrays, things that produce results that can be measured in price movements in the past that you can build confidence on. Will you do them in the future and do it wrong? Yes, I do. But they will serve you most times better than if you didn't use them at all. It provides context to price. It gives you the storyline. Where's the turning points? Where's the real support and resistance? Where's the point of retracement? Where's it going to go to? Where could you reasonably expect the retracement to stop? Think about that. That's everything that every friggin' book out there won't touch because they don't know. You don't think that there would be dozens of books, encyclopedias on price action the way I'm teaching? If everybody else knew this, if this was rebranded, why the fuck isn't it in all these books? Because it's not. It's not there, folks. I don't care how many ass-hurt little people that can't run their own businesses, can't sell their shit on their own merit. They got to come up with this nonsense to justify why they suck. They suck. They can't do what you're learning to do. They can't call it live. They can't call it minute by minute. They cannot do it. But they're going to shame you so that way you don't become better than them. Just like your friends and family. If you tell them what you're doing, I promise you, you're going to get the opposite of what you expect to hear. You want to hear your brother, your sister, your cousin, your mother, your father, your boss, your coworkers. Oh, that's a great idea, Bruce. You know what? You're going to do well. You're going to do well at that. If anybody was going to do it, Bruce, you're going to do it. No. Carl is going to tell you, you're going to fail. You're going to be working here the rest of your life just like me. But I'll be employee of the month. Well, screw Carl. Don't listen to Bruce. Your family members, they don't understand what you're doing. Believe me, not one of my family members, even my uncle that got me into this, it was funny watching him when I was a teenager, cheerleading it because he made money in the sugar market in the 80s. He's like, Michael? A lot of my older students know this story. I'll just make it real brief. Michael, when you get out of school, get yourself a college degree, become an electronic technician, because that's what he was at Westinghouse, and do what? Learn how to trade futures and options. The richest people in the world, Michael, trade futures and options. Now, this is my uncle who made money. He ended up buying a condominium in Ocean City, which is not a big deal, but back then that was a big deal. So, of course, as a typical teenager, 14, 15 years old, I'm like, oh, stock market? Yeah, I'm not interested. We would watch my martial art movies and go to my martial art class and hang out with my friends. That's what I was interested in. I didn't worry about money because a kid ain't interested in money. But then when I started doing this very thing in the 90s, and he saw me doing well, he actually turned around from becoming a cheerleader to, why are you doing well? And I've done this longer. And when I was paying room and board, because I moved out of my grandparents and moved in with them because I wasn't prepared to do much I basically was a hospice nurse for my grandparents and a student and married too young. So I was doing too many things, plate spinning, failure in every aspect except for taking care of my grandparents. But when they got too sick, one, my grandfather passed away, and my grandmother had to go to a nursing home because we couldn't take care of her anymore. Incontinence became a factor. My aunt and uncle said, you can stay with us until you get on your feet. Great. So I'm in school trying to get my computer science up to par so I can get my job as a systems analyst. That was what I was trying to do. And I got involved in the trading. And one of the critical points in my development was when I told my uncle, I said, look what I'm doing here. Now, this is the uncle that introduced me to trading. At 14 years old, all he could talk to me about on Sundays at my grandparents, trading. He bought his wife, my aunt, a Fiero, not a Ferrari, a Fiero GT, which was a cool car back then. And I loved to sit in it. And I was like, man, I want to have this. And they had their house. Everybody else rented, and they own a home. They're paying a mortgage on it, but they had a swimming pool. And to me, we had to go to an apartment complex up the road, which was Maple Crest at the time, to go swimming with somebody that was either a friend or a schoolmate that would be, a resident there. That's the swimming we did. Or we went to a creek, that's the way it was. But here I looked at him, I'm thinking to myself, you have all these things. I want to have those things too. And it inspired me to do things that would have otherwise been like the rest of my friends. They just didn't care. They didn't want to do anything really. They were lazy. And they all live lives that show that today. They never really put any kind of real effort into building past what would ever be considered just the average wage earner's lifestyle. And when I started showing my uncle, I said, look what I'm doing here. Here's the 50-day moving average. I'm using that as my bias. If 9 days ago, the moving average was lower than it is today, that means I'm bullish. Then I waited for a 60-minute oversold condition on a stochastic, which was the lines that you set those stochastics was 5 and smoothed by 3. That was the settings I used. And I looked for a bullish divergence, type 1, or a trend following. They call it hidden divergence. And Nick Van Nuys was the inventor of that. He's the one that brought it to the community. He never gets credit for it. It pisses me off that everybody else knows what a hidden divergence is or a type 2, but he's the only person that ever brought it out. He did that in the 90s, and he never gets credit for it. But that was my buy signal. That was my buy signal. And I only wanted to go long because I didn't understand selling short. So I started showing him the results of doing that. And then as soon as I would tell him that I'm trying to buy either wheat or I'm trying to buy live cattle or I'm trying to buy crude oil or copper, he's going in with his real account, fading it, going the other direction. Well, I don't need to tell you how that ended, but he got really argumentative, where I was looking at we're going to learn how to do this together, and it's going to create a better bond between the nephew, the uncle, and it just complete the circle. He introduced me to the idea of trading when I was a younger kid, and here in my 20s, I'm actually now doing it. And because my analysis was right, and he was fading it, he wanted to be able to say, he beat me. That's what it came down to. He wanted to be able to do the opposite of what his nephew, the kid that he was encouraging, but no longer was encouraging. I was able to do something he was unsuccessful at because he only got lucky in sugar. After that, lost. And I understand why. He's a book smart guy. He graduated with a finance degree, business administration, specializing in finance. That's where he went to school in University of Baltimore. And he is analytical to a fault. He wants black and white binary. It only can be this. And he's a natural contrarian. And I tried to tell him, this is how you use your personality like that. This is a model that to do that and do well with it. Wouldn't do it. Wouldn't touch it. Even though I was showing him proof. This is what it looks like. This is what it will do tomorrow. Boom, it did it. Never touched it. Failed. So, when I got my oldest son's mother, who was married at the time, I didn't know it. And yes, I had a relationship with her that resulted in having a son. He's my oldest boy. He and I had a conversation. I said, listen, I want to hide from this woman because she's a gold digger. And I said, let's put some money into an account together, but the name will be in your name. Okay, that's great. I said, so what we'll do, anytime I need something, you just pay for it. You're not giving me cash, but if I need something, you just pay for it, okay? Great, no problem. Well, we put money in together, and I was supposed to be deciding what we do, and that didn't work out. When he got involved in making his own decisions, and he lost half of what we put in, he took his half out, which was the remaining balance. Now, talk about a screw job. Yeah, that's exactly what family did. It was my half that we lost. His half never got any, there was no losses there. He gets to take all his money out. So that's what I'm telling you about money with family and trading with family. You can't mix those together, folks. Your best friends even, you can't do that. You can't do it. So love them from a distance. Do what you got to do. Keep it to yourself. And there it is. Now, you can create partnerships. And I've had partnerships over the years where everything is off the books, if you want to say it that way. And you can develop really good friendships like that. You can be an angel investor with your skill set and never bring any money to it. And when you need help with something, they're there to scratch your back. And unfortunately, I had to live like that for a number of years because a gold digger knew I had a skill set that was going to lead to a better lifestyle than her husband was providing her. And my friends at the time did me a great disservice by telling her where my pursuits were. So she had insight that I didn't know she had. And yes, I take full responsibility of having relations with her that resulted in my oldest son, who I love. But we raised him with joint custody. And I had to do a lot of things to live away from her reach. And maybe you wouldn't do those types of things. Maybe you would do something entirely different. But my son did not want for anything. Did not want for anything. And when I was working at Domino's, I was doing that so she wouldn't get more than she should have gotten. And any time I could have stopped. And I shared on Twitter years ago a picture of me when I stopped in on my birthday. I'm sitting in my Domino's uniform. And I'm taking a bite of my birthday cake, ice cream cake, and my mother took a picture of me. And the face that I'm making, you can, like, I at that day, I was thinking to myself, do I really want to put myself through this? Like, I don't think I'm doing the right thing. And every time I thought about her getting more from me, because she was an opportunistic person. This is not a sexist remark, okay? She was calculated in what she was doing. And only when she got pregnant, she told me she was married and she had a son I knew nothing about. That's some low, greasy shit. And here I am, I'm 20 some years old, fresh out the box, ready to run. And I have all this. So I had my son 5 days a week, except for Thursdays, which that was her only night where she didn't run around doing her thing, and she'd have him then. So I was not a deadbeat dad, and I had all the problems that you might consider that's a disadvantage for you. I'm a single parent, ICT. I don't make enough money, and I got this problem. I got to go to school. Listen, there ain't nothing you're going to tell me that I didn't have to. I had adversities too, man. Believe me, I had all that. It wasn't easy for me. And I can see how the Lord laid my steps in accordance to how he led me to where I am right now. Everything happened for a reason. And while you're going through it, you feel like it's the worst thing that could ever happen. It's you're being held back. You're being hindered. Sometimes that's a good thing. Sometimes it's better for you not to be so successful right away. Sometimes it's better for you to wait and defer what you know you can do until a better time. My uncle, I wish he would have been more successful trading. I actually gave him access to my mentorship. Didn't use it. His pride won't let him do it. Think about that. Most of you out there that are still emailing me know you can't join that private group, so please stop asking. I'm not trying to be ignorant to you, but I'm reminding you, I'm not selling a mentorship. You're not joining it. You can't get into it. That community is closed off. But most of you would chew your own arm off to be able to get in there. And I gave that to my uncle. I said, listen, just join us as part of the community. Nope. He signed in one time, and that was it. Never, ever, ever signed in again. That's a bitter person. That's bitterness. And it makes no sense to me. It makes no sense at all. Like, I would literally drive to his house every single day because I love him. He's been like a father figure to me. As much as you hear me saying all these things, you might think I have a poisonous, venomous view about him. I don't. I feel sorry for him. I would literally drive to his house, buy a setup, set his trading room up with my own money, fund him with my own money, and sit down with him and teach him until he knew how to do this on his own. He won't do it. Tell me how to make that make sense. It doesn't. It means he's bent. It's warped him. And I've seen that in other people that have nothing to do with me. Just other traders that just get out there. And it just eats them up. Like a cancer. Mentally, they just can't do it. They have no discipline. They are the problem. They can't see it no matter how much you show them that they're the problem. And that's, unfortunately, I think that's what most of this industry's failures are stemming from. It's not just the fact that the retail stuff is garbage. How we are to think about ourselves, how we conduct ourselves, how we are to handle adversities, stresses, losing, doing things incorrectly. That is the factors that leads to people not being successful in this industry. And that's why I like a lot of books that are revolving around psychology, substance abuse. I've never drank alcohol, and I don't take pain pills, despite what many people will say. I'm pretty straight air. If I take an Advil, I feel that, one Advil. And it's rare that I need to do that at all. I don't take medicines. I should, I guess, in some medical professionals' opinion, maybe some of you as the listeners, because I'm bipolar. But I refuse to take a medicine like that because it would alter my state and my ability to focus. And it would change who I am. I'm not going to do that. So you have to take the good with the bad with me. And sometimes I'm going to not be Mr. Stable, okay? I'm doing my best. I think I'm doing pretty good today. But usually, sometimes I'm not very successful with it, and I go off the rails. But you're getting truth even then. You're just getting it much more passionately delivered. But you don't realize what you're bringing to yourself when you get involved in this. You think it's just the charts, and it's not. It's what's going on in your personal life. It's what you're feeling, your fears, your impatience about the success that you so painfully want to happen real quickly for you. And these candlesticks, they are going to be perfect vehicles for you to manifest impulsiveness, to manifest impatience, to manifest fear and greed. So the reason why I tell you, and I preach this really hard, that you should not be learning how to trade with a live account. I don't care if anybody tells you, put the smallest amount and trade with a small amount because you can't learn to trade without putting money in there. Wrong. I don't care who you are. I don't care how many people follow you. Period. That is the stupidest advice anybody should ever receive or give to anyone else. The only thing you're going to get from that is the development of fear and regret. Oh, I wish I wouldn't have done that with real money. $20. $20 is nothing, okay? Would you go down the highway and just toss out $20 every morning at 9 o'clock? It's not a lot of money, but would you do it? No. That's what you're doing when you trade with a live account without knowing what you're doing. Seems like a silly analogy, but that's what you're doing. You're throwing money away, doing it consistently the same way, not knowing what you're doing. If you're telling me, or going to make the argument, that you're not going to learn how to read what price is going to do without having a measurement applied to the candlestick that you're looking at, you need money to do that? You need money to be able to see if that candle isn't performing like you want it to. What are you looking at then? Because I'm giving you very specific PD arrays, things that you are going to absolutely go in there and study specifically. It's not ambiguous. These are very finite levels. They're very specific. There's a reason for why I'm talking about them. And are they respecting price? Are they gravitating to them? Are they repelling them? You need to have a live account with some kind of risk on this to see that. That makes no sense to me. It makes zero sense. You need to learn how to be indifferent to the result of every trade. Because if you don't lose this fear that you have right now of being wrong, the only way you get over that is by looking at price action when there's no trade on. You're not even pressing a demo. Because in the beginning, men, your pride is going to get bruised real easy. And you're going to have that measuring up factor step in. You know what it's like when your girlfriend talks about their ex. You know exactly what I'm talking about. You start doing that with your trades. And unfortunately, that's the worst thing you can do. Remove any measurement of success or failure by having no trade placed. None. Reading price, interpreting what price is likely to do next, studying it. How do you feel while you're watching price? Do you feel anxious? Do you feel restless? Do you feel like you're impatiently waiting for something to happen and or bored? Are you bored? Not in the sense that you're bored not learning what you're doing, but you're bored like you'd rather be doing something else instead of learning how to do this. Because that's a real thing too. And if you don't want to be looking at these candlesticks, you're going to fail. Okay, I mean, that's what we do as traders. We look at price action. Whether you're looking at indicators or whether you're looking at just naked charts, you got to submit to that. That's part of this whole business. And you'd be surprised how many students have come to me over the years. They're like, I can't do this. This is I don't have it for me. Okay, that's being responsible. That's you being realistic about it. It's not the fact that these things don't work. It's just the fact that you can't do it. Well done for being responsible. But that's not what's in vogue now. What's in vogue is failure because they don't want to put the work in. They have not done what they were instructed to do. They haven't done it long enough. So therefore, laziness, it doesn't work. No, you don't work. You're not working hard enough. Because there's people around the world, all different walks of life, that are taking this information, the same information, and doing extremely well. That's undeniable. You can't argue it. You can't beat it. You can't defend against it because it's facts. And they're doing trades that I don't put them in. So where did they get the information from? Their own model using what was instructed of them. Taking it and making it theirs. And that's how I teach. You can't do it any other way. Now, if I have a model that says, hey, this is the only way you're going to do it. This, and that's it. Some of you could do that. Some is not my goal. I want all of you to have the same opportunity to be able to make your own unique model with this information. And worrying about, they're going to change the algorithm. They're going to change things and make it impossible for this and that. Listen, the only way this stuff stops working is when there's no more trading entirely. That's it. As long as there's trading, this is going to continue to work. I've said it many times in the past. I've tweeted it many times in the past. This is not going to stop working. Period. There's going to be an open. There's going to be a high. There's going to be a low. There's going to be a close. There's going to be a gap that forms on Sundays sometimes. There's going to be a gap when it opens back up at 6 o'clock. There's going to be an inefficiency in price delivery. That is what you don't understand because you're an infant in this. You're so new. You have no idea because you haven't done any real research in old price movement. These things have gone on forever. You just have never been brought in front of the chart and looked at it and identified it as such. And that's what I'm telling you. You have to do that. Yes, you got to stop hanging out with your friends and your girlfriends and watching stupid TV programs and movies and wasting time playing video games. Go into these charts and take time studying them. Look at old moves. Break them down. Explain it to yourself like you're teaching someone else. Say, this is what I see in hindsight. I'm going to explain what took place here using the logic that I teach in price action. Now, you see me do it live, minute by minute candles. You do the same thing you see me outlining, but you have the benefit of hindsight. And then after you're done annotating your chart, reasoning with why it did what it did, who was going to fail, who was going to lose money, who did the market move against, why, and how could smart money be an opposing liquidity to that move that would be profitable for them, and how did it hurt retail? You go into your old moves like that. That's how I back tested. That's how I teach my students to back test. It's not pushing a market replay and watching a trade pan out. That's a walk forward test. That's not what I'm saying. Before you even get there, you got to spend time in old price moves, annotate your charts, walk out the whole details of what you see through the benefit of hindsight. And you're going to see these recurring things repeat over and over again. And then you'll be confident when you see me tweeting, note this fair value gap here and note this buy side. What am I saying when I do that? Did I say buy the fair value gap and take profits at that buy side liquidity? No. But you know damn well, if you've been around for a long time, you're expecting me to do a trade recap later on, or screenshot this and do a victory dance, because it's drawing to where I told you to look for, keying off of that fair value gap. That's not a signal. I'm not going to place you in a trade, but I'm teaching you how to anticipate. I'm building your anticipatory price skills. That's the first step. You have to know where it's going. If you can learn that skill set, I promise you the entry stuff is easy. When I do my trades and I'm building pyramided up positions, I'm literally using every potential trading entry that you could utilize in that fractal at that time. It matters not if you use the very first one I use. Go back and look at my examples on Twitter. Every time I do a trade execution, I don't put it in my private mentorship. I put it out where everybody can see it. Look at what I'm doing. Every one of those is a example of an entry. Which one makes most sense to you? And don't look at it from this perspective of, well, this one would have had a smaller stop loss, so that's the one I want. No, which one makes more sense? What are you seeing in that example of me entering the trade and when I'm building up the positions and I'm pyramiding, adding more to it? Which one of those entry points makes the most sense to you and why? And that's where you want to start. That's where you start. That's the very point at which that's the first beginning step to how you work in your entries. But we're not at entries yet. I promise you, we will be pushing the button. I will be pushing a button in this in front of you. I will be doing that. But before I do that, you have to understand, why am I even interested in buying or selling? It has to be going somewhere. It has to go somewhere. It has to be a reason for it to be wanting to go there. There has to be a logic behind it that I've already taught. I can't be making something up as I go along. And these are always the same arguments. He's always got something to do something in any market environment. You're damn right. Because the market doesn't just do one thing. It's not a one-trick pony. I want to be able to trade when I know the market's going to create a high on Tuesday or a low on Tuesday. How about when it makes the high or low on Thursday? How about when it makes the high or low on Thursday on the New York session? I have macros for all that stuff. I have a playbook. Okay? I have a playbook that if I was an NFL coach, they would be breaking in my house to get this. Okay? It's not, it's not literally here, it's in my head. But the point is this. I have a game plan for more than one way to beat the shit out of these markets. I don't want to be stuck with just one approach. I'm not a one-trick pony. And I promised you at the beginning of the year I was going to show you things that you haven't seen yet, even my private students. Different entry models, different approaches to entering the market, analysis concepts. I got weapons you guys have never seen before. And you don't need them. I've already given you enough. I've already taught you how to trade. But what you need to do is do this. Sit here and watch price. And if I wasn't talking and jawboning to you, you'd probably be bored to death and probably pissed off because I'm jawboning about what I'm talking about. You're not prepared to be here then. If you can't sit here and listen to this, because this is what you're going to have to endure these things. If you're going to be a trader, you're going to eventually have these problems that you're going to contend with. The wrestling matches in your mind, or if you share your results with somebody else, how they make you feel. Who cares what anybody else's opinion about your results are? You shouldn't be sharing them with anybody anyway. You think they're going to cheerlead you on? Wow, look at you. You're the GOAT. If you need that, that's a character flaw. That means you're weak-minded. I don't want people calling me the GOAT. I don't want anybody cheering me on. No worship, no none of that stuff. I'm not a king. But this industry is going to show you a lot about yourself that unfortunately is going to be really uncomfortable for you when you discover you probably aren't as equipped as you thought you were. It doesn't mean you can't trade. It doesn't mean you can't develop into a profitable trader. It just means that you're going to have to fix those problems. Those kinks in your armor, they need to be hammered out. And unfortunately for men, that doesn't happen real fast. Which is why you see a lot of people on social media making pseudo wars and competitions and I'm better than you and you're better than nobody else and yada this and yada that. Because they have a character flaw. And you can't help people like that. They have to wrestle through that themselves. And why would you open that up for yourself? If you know that you're feeling this impulsiveness about wanting to go out and show your results to somebody else on social media, whether it be me or anybody else, ask yourself a question. Why do you want to do that? What are you wanting to get from that? If you're needing encouragement, that means that you're not satisfied with the continuity and consistency and frequency of what you're doing. Because I don't need anybody to tell me this stuff works. I know it does. I share it so that way you can be encouraged by it.
I'm a teacher. I'm teaching you. I teach my students to cheerlead themselves when they watch price go to the level that we've outlined beforehand. That's not gloating. That's not bragging. I'm making a moment emotional for you. So that way you can say, oh, wow, I sat through this. I watched it deliver. Wow, it really did that. And it makes it an anchor point for you mentally. So you remember it. And you'll be more inclined to do what with it? Journal it. This was a great day today. I watched this price action move here, blah, 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 blah. And there it is. Now it's in your journal, exactly where it needs to be. And then on the weekend, you're going to go back and read it in your own words, and you say, it was really interesting to watch how this happened today. I was so happy to see how it unfolds. You're giving yourself a cheerleading session. You need to do that. You don't open up the opportunity for some trolls or pseudo competitors or people that just have no interest in helping anybody else. They just want to detract, discourage. There's no place in that. Well, no place in your trading or in this industry for that. It doesn't make anybody better. It just shines a light on them as a pathetic piece of shit. So why give them the opportunity to do that? You're not going to get what you want, really. You might get a couple people, especially in our community, we'll be like high-fiving you, that's wonderful. But really think about it for a second. Why do you need that? Why would any of my students need to do that? The only reason why that would happen is that you haven't seen enough of it for you to be bored by it yet. I have a lot of students that are there now, and that's why there's not a lot of them worrying about whether they believe you or you believe them. They don't care. They're doing it. Do you honestly believe the folks that I'm interviewing that are making the money they're making, do you think they really give a shit whether you believe that they can do it or not? Is it having any impact on what they're going to do tonight, next week, by the end of the year? It has no bearing. They don't care. They have found what they've been looking for. Nobody's detracting them. No one's going to convince them that they didn't do the right thing by sticking with it. And I promise you, they're not in a position where they got to feel like they got to constantly prove anything to anybody. They're living it. They look in the mirror and they say, there's my evidence right there. You're the person that did that yesterday. Wow, you did a great job. But the weak-minded individuals that feel like they have to be reminded, they got to be pinched that it's real. That's normal in the beginning. It's normal for you to feel that way. That you got to feel like someone else can confirm what you're doing. It's real. Like, yeah, you really are trading. Yeah, you really took that money out. It's not a dream. It's happening. That's understandable in the beginning. But if your steady diet is you got to constantly keep going through social media with it, if you're profitable, you don't need to do that. Because your profits are going to tell you everything you need is going to either be you're losing and you're off your model and you're not doing what you're supposed to be doing and you're getting immediate feedback, or you're following your model, you're making money, and who cares what anybody thinks? You're doing it. You don't need anybody at all to co-sign that you're doing it right because you're making money. That's a goal for all of you. You need to get to that point. And there's a goal before that where you get to see where price is likely to go next, and you're bored by it going exactly how you want to see it happen in your charts. I love sharing it with you on Twitter and live. I love it because I know what it felt like for me when I started feeling like I was close to it, and I would get these once in a while beginning moves of consistency and continuity in my analysis. That was, I needed to have that sounding board where I could bounce an idea off of somebody and say, look, this is what I've been doing. Do you feel like this is something that I should pursue? But I didn't have that. So I had to do what? Stick to my journals. And most of that in the beginning stages was me failing and learning from them. I didn't look at the failure as a denial. It just meant that I had to spend more time doing it than I thought I was going to have to. And because I'm impulsive, I'm obsessive, and bipolar, I had a real hard time wrestling with that. And it wasn't until I started attacking the mental side of things that are not really trading. It's the shortcomings as a human being, the things that we want. Like I have a deep-rooted desire to be affirmed by a family member that's passed away. I can't get that. And as much as students that tell me they're thankful and they're appreciative of what I do and how much time and effort I put into this, that's great, and I'm thankful for that. But I'm not satisfied. I'm pursuing something that I'm not going to obtain, which is frustrating for me. And that was a real struggling point for me as a developing student, because I didn't know how to deal with that. I allowed it to take me off the rails in my trading. I allowed it to blow my accounts because I would just say, okay, I'm just going to go in there and risk it all, because I'm at a point where it needs to be a win so big and astronomical and unrealistic, or I'm willing to lose the entire account just to be out of it right now. And each time I did that, what I was asking for was trader suicide, like suicide by cop. You couldn't do it to yourself, so you go out there and run in front of a cop and have them draw down on you. That's what happens. And you might listen to that and think to yourself, wow, that sounds morbid, or some of you probably be laughing about it, thinking, yeah, it makes sense to me. But that's essentially what's occurring when people blow their accounts. It's like that numbness that a gambler gets when they're in a casino, where they're just throwing down bets and they just want it to end. They don't have the discipline to get up and walk away when they know they should. So they want the game to remove them because they don't have the discipline to get up and walk away and stop. I didn't have the discipline when I was new to turn the charts off and walk away. I was afraid I was going to miss the move because I lost 3-4 times already. The next one's really going to happen now. And if I leave, it won't be able to get me back to break even and make more money. So because I didn't know how to submit to that or understand what I'm teaching you here. Look what the market's doing right now. Is it going up or down? It's consolidating. Isn't that what we outlined this morning? Sideways. When does the market consolidate? ICT has taught you. ICT has walked you through it. It's right here. Do you want to trade in this environment? I don't. But there are some of you that may see this and say, oh, there's a setup here. There's a setup here. There. When I show the chart like this is how I have my charts like this. I'll come back to that psychological thing in a second. But if you're a scalper and you have your charts like this, suddenly the out looks more impactful. Like, well, yeah, this is a move. Look at this move right here. I'm not chasing moves like that. I can trade all these little minor fluctuations, but to me, it's not worth it. It's too much babysitting a stop for such a small, insignificant, minor move. In a condition I already know it's likely to do what we're seeing here. And I've kind of like presented that to you before we got to where we are here now. But the point at which when a trader gets to where they throw all logic right out the window and they submit themselves to their emotions or the whims of their psychological weaknesses. Here's what you're going to have happen if you trade with live money before you know how to trade. Okay, and I promise this is going to happen to you. Nobody will be exempt from this. Or if you have a vendetta that you want to prove something in the public and you really don't know how to trade and you don't have any discipline and you don't have any risk management, you're going to do impulsive things. You're going to have max loss days. You're going to throw away a good winning day trying to be better than you need to be. Make a little bit of money here, make a little bit of money there. You're not satisfied with that because you want to prove something to the world, and then you lose it. That doesn't show superiority. That puts a bullet point right on what everybody else watching you sees. You're not really all together. You're not as professional as you pretend to be. You're not a good trader. You're reckless. You gamble. And you have no self-discipline. If you're in that condition, you blow your accounts because you're trying to have a experience that's outside of trading and profiting. You want to have an Olympic event. You want to make something like it's a movie. Like you've made yourself the main character in a movie that's not really going on. But you're sitting in front of your charts And you have this mindset that when it goes up here, the crowd's going to cheer because I'm the underdog, and the villain that I'm up against is going to fall by my hand. It's silly, I know. But think about it. Some of you men, that's exactly what the hell you're doing. You're looking at these charts manifesting some kind of B-movie plot. And that's the reason why I presented a lot of things I did on Baby Pips, because I knew my audience was men, predominantly. And that's true, ladies. That's the way it was on Baby Pips. I had a few ladies in the collection of people that were following me over there that I knew about, but predominantly they were mostly men. And I did everything male. Sniper this, military that, because that was my hook. It got you looking at something. Oh, and then because I'm showing you something, and it had the music, and it had the sniper theme things, and that would make the males do what? Pay attention. And anybody over on Baby Pips that was trying to draw a crowd for themselves hated me because I was effective in drawing a crowd. And someone would literally go on the social media forum of Baby Pips and cry like kids. I don't know why nobody's paying any attention to me. That's a character flaw. And when you trade with live money without knowing what to do, when you're not conditioned, where you're bored at reading price action, you know what it's going to do. And it sounds ludicrous to people that come in this industry and they buy the bullshit that's in these books and says, nobody can time the market. Nobody knows where the market's going to go. I fucking know where these markets are going to go. I'm proving it every single day. I know when it's not likely to do something, so I'm not going to do anything. How much more of a testimony do you need when I'm doing every day? That's not arrogance. That's just reminding you that that's logic, that's fake. They want you to believe that you can't do this. They want you to believe that it's random. They want you to have their faith in all these indicators and these bullshit approaches to reading things in price that have no bearing on why price goes up or down. But if you go in and you're trading with live money and you have not been conditioned to anticipate where price is going to go, why it should go there, and you have not seen months of being effectively accurate, not once in a while getting it right, okay, let me go in here and start doing the funded account challenge. No. You have to know exactly what you're looking for. Most times, what does that mean? 70% or more. If you can't be 70% accurate, you have no fucking business trading with live money. And that's just the truth. I don't care what anybody tells you other than that. That's exactly how it should be. Because if you can't see what the market's going to do 70% of the time, you don't know what you're doing. And 70% seems extremely high, but it's really not. If you factored out all the times where you fell victim to trading in environments like this, if you took all those trades out, go back and look at all the bullshit you've been doing in your trading. How you lost your money, how you blew your accounts. It's environments like this. So if you listen to good old ICT and understand that this is how we stay out, we don't trade in these environments. How better would you have done if you take those big losing or blowout days or account blowers, take that out of your trading? You'd still be in the game. Again, nobody's writing books about it because they don't want people feeling bad about themselves. They want them to buy books and get excited and hopped up on goofballs that they're going to get rich. I don't present things like that. I don't do it like that. And that's why people don't like listening to these rants. They don't like listening to this stuff. Oh, he goes on and on and on. Teach ICT the better way. Give me 2 sentences, and then that's the better way. And you're still going to lose your fucking money. And you're going to wish you had these points in your understanding. So you're in a hurry. You're making perfect excuses for getting out there before you're ready. You teach ICT better. It's so right to the point. Yeah, get to the point of losing your money. There's a lot of people out there trying to teach what I do, but they're not equipped. You just know part of it. And the folks that have tried that with other people, Smart Money Concepts through this guy, that gal, this organization, this multi-level company, and they wreck themselves. Then they find me and like, oh, something different. Now I'm making money. Now I can find it, and it's making perfect sense now. Well, what's different? What's different? The person that created it all is talking about it, teaching you what matters most and what to do, what not to do. But when you get there with a live account and you know what you're doing, this weird experience comes over you where you get to the point where you know subconsciously that you're not equipped to be doing what you're doing, but you don't have the discipline to stop. So you start pressing the button and you just want some kind of miracle to happen, some reason to inspire you to keep going back to the studying part of it, because you don't want to. You don't want to do that. It's hard work. It's boring. All these people are getting withdrawals from their funded accounts. All these people are winning competitions. All these people are showing their profits. They're buying this and they're showing that. I want to do that. That's trading. No, that's people living on social media. Are you trying to be a trader on social media? Or are you trying to make money? Are you looking for your equity curve on social media to go up more than the equity in your account? And I'm telling you that hits it right on the head right there. So many people want to be viewed as a baller on social media than doing it just for real in their own accounts and being satisfied with that. That's how you know if somebody's really making money. Because if they got to constantly reward themselves in front of everyone else and show the world what they're doing, that's all they have. How frequently are they doing it? Not much. And that's what keeps them motivated, because they don't like what they're doing, because their successful results are not consistent. And they'll go into a live account, and those individuals that rush in here to try to trade with real money before they know how to read price, they'll have that gambler's numbness come over them. And it's a real thing, folks. You get in this mindset where, hey, I don't want to stop trading because I don't have the discipline. And I'm going to keep pushing the button until it takes me out. In fact, there's been several times when I was younger, I literally screamed at my chart. Screamed at it. F you. Take all of it. I'm not stopping. I don't care. You're taking all of it before I stop. Now, does that sound like someone that's balanced and should be risking their money? Absolutely not. But I guarantee you, some of you probably won't have the courage to say so, but you've done that. You literally cussed at the market. You personified it like it picked your pocket. And you dared it to take the rest of it. And it did. And then you were mad about it. I can't believe I lost my account. They did it to me. No, you knew that was going to happen. And you knew you should have stopped trading. You should have turned the charts off and walked away. But gambler's numbness came over after you, and that's just the way it is. That's what happens. Because internally, what's going on is you're wrestling with, okay, I have a losing trade here. I don't feel motivated. So I don't want to go back to the charts. I don't want to study. I don't want to back test. I don't want to look at what I've done wrong because it's too painful. Well, guess what, Dorothy? That's what it's like in Oz. Okay? You're going to have those problems that you have to deal with. You have to go back and look at your journal. What did you do wrong? Okay, that wasn't that fun, but what did you do right? You focus there. You focus there because you have to be your own cheerleader. ICT is not going to be there. I'm not going to be, I don't know when you are doing those losing trades. I don't know when you're in there over leveraging and trying to make something happen because you want to get on a leaderboard. You want to make a big withdrawal, 5-figure withdrawals. I want to be able to prove that this stuff works. I'm not expecting you to prove it. I didn't ask you to do that. But all of you are having these vigilante type B-movie plots that you want to come out here and prove that you are a warrior. You're the main character in a Steven Seagal movie. I know. I used to do stupid shit like that when I was 20 years old. Music playing in the background. Yeah, man. I got nobody to share it with because we don't have social media back in the 90s like you all have. It was just me fantasizing, like, yeah, here it is. I'm going to win. There it is. The music's going to be playing, and boom, hit the credits. There it is. The audience is going to love it. Who's the audience? Me. Me. I couldn't even talk to my uncle about it. I told you, sorry. So who did I have? No one. Not one person. So I understand if I would have had that, like you all have social media today, you'd be out there sharing everything. I'd be out there sharing it too. If it was available to me back then, I would have done it. And it probably would have been more detrimental to my development than not having had it. That's why I'm telling you, don't do it. I know my own character flaws. I know the imbalances I have chemically that I can't do anything about, because I won't take a medicine for it. I don't think it's medicine. It's a drug, and I don't take drugs. So the drug I like is winning. I like getting high on winning, and you can see I love it because I share it every day on my Twitter and when I'm doing the live streams. I love it. I love it. It's contagious too. That's why my students talk like me. That's why my students trade like me, because they love fucking winning. It feels good. And when you do it and you see other people do it, you want to be a part of that. Call that a cult? I don't care. I call it a circus. It's fun. It's carnival. Everybody gets to do what they want to do. No one's forced them into it. And they all have fun while they're learning. And you have to motivate yourself that way. You have to. You can't let gamblers' numbness go over top of you. When that happens, when you feel like you just want them to end it for you, you have to dig deep and say, that's it. I'm down big for the day, but I'm not out. I'm turning off the computers. I'm turning off the charts. Even if you got to go tweet to me and say, ICT, I got it. I'm feeling it. I'm in drawdown. I'm done. I turned the charts off. I'm going to do something else. I'll see you in a couple of days. What did you just do? You made yourself accountable. You've done the best thing you could do, which is identify where you're at. This is how you prevent yourself from blowing the account. I'm telling you, every single person that has blown their accounts, and there ain't one of you out there that's traded with real money that haven't blown an account. You have. If you say you haven't, you're a fucking liar. Okay? I've dusted probably 10 or 11 accounts. I've done that. And guess what that means? I had a lot of learning to do. I had to come up through harder times than you. And you have all these advantages. And you have somebody talking to you that has been there and done it. And it's irritating when I see these young people bitch about how, oh, he just talks and talks and talks. You're a moron. Seriously, you're a moron if you don't want to hear how to prevent yourself from failing. You're a person that's acting like you know everything. And you want to cherry pick what information you want to get when you have no idea the benefit of having had it, because you don't trade with real money. And when you start trading with real money, all these things are going to be real important to you then. And I hate when I see students that had that mindset, came to me, didn't want to listen to the dry, boring shit, where the real learning is. They lose, they hurt themselves, and then they go back and listen to the stuff, and they're like, what I fell victim to, you taught in this lecture. If I just would have did that, this wouldn't have happened to me. Exactly why I said it. I don't like hearing that you didn't listen to good advice. I don't like hearing that. Because I feel like I missed the mark when I know I didn't miss the mark. All of my lectures are all predominantly psychological and risk management. Unless I'm pointing to the chart, I'm nonstop telling you exactly how you are going to survive or do yourself in. I'm not afraid to say these things and not be popular. I don't care. I don't care. I've been out here teaching with a demo in paper trading the entire time, and yet people still find themselves profitable, still find themselves able to read the price action. I've never cared about anybody's opinion on how I do it.
how I do it works. You have to align yourself with what I'm doing, how I'm teaching it. And if you can't, good luck to you. Promise you, you'll do something else and then you'll come back here and then you'll discover if you just would have listened, you could have avoided all that pain. You could have avoided all that time wasted. Let me ask you something. Let's say, for instance, that Michael Huddleston, the guy talking to you right now, let's just say that I had a PhD, okay, piled higher and deeper. And say, just for instance, that I was a big wig at some bullshit investment bank, okay? And say that I had a speaking circuit where I went around and I talked to Fortune 500 companies and brokerage firms and all that bullshit, okay? Say I did all that stuff. And then I talked to you about these types of things. You know what you would do? You'd be all ears. You'd be writing down all that bullshit. Why? Perception. And that's why you chase all these social media people. Image. You fall victim to that. I'm giving you the real work. I'm telling you what the market's going to do, why it's going to do it, how to avoid hurting yourself with it. That's the real thing. Goldman Sachs ain't conditioning their students and traders to do that shit. You're learning from the trenches over real price action live that there really is a technical science. Give me a second here. I got to take a look at the other markets here. I talked and let my monitors go to sleep. All right, so dollar index has swept its 104.92. That was sell side on the 1 minute chart. Let me pull up a Dixie chart real quick. So we've taken sell side here. Small little imbalance here with buy side. So we'll see if it wants to draw up here. That'll be a little bit more weakness on ES if it does that. If it fails to do anything like that or goes up there and then rejects that right there, that sell side right there looks really doable. But I would want to see it go above here, this fair value gap, which I'm not going to draw. Draw that in time. If it goes above that and comes back down and acts as support, we will be looking for a higher run on dollar and weakness on indices. So let's go back over to ES. We'll stay in the 1 minute chart. Got this oriented here for a second. Hold on. Okay, so that's what we're looking at. These lines here. That was what that was. I was trying to figure out where those blue lines come from. I don't remember putting them in there, but it's based on the 5 minute chart that we've been jawboning about. So that wick here, I'm going to take that off. That consequent encouragement order block, I'm taking that off. Mean threshold, I'm going to keep that here because we're in close proximity to it, but I'm going to add consequent encouragement to this wick right here. I don't know how many people are listening. Like, I don't want to look at how many people are listening to me when I'm live. I don't do that when I'm doing like Twitter Spaces either, because I like to pretend I'm doing just the recordings where I can just talk freely and not feel intimidated, because I am very intimidated by having a large audience. I might sound like I'm real extroverted, but I'm an introvert. But I'm certain that I lost a lot of viewers this morning with the conversation I had, and that's good. That means I'm filtering out the ones that shouldn't be here. All right, so I'm going to take this line here, make it blue, and then we drop down to the 1 minute chart. You'll see it and know what it is. All right, and then we'll add one little
line here for sell side on this low. I'll make that dotted. So that way we can differentiate what it is. We have a city here, sell side imbalance, buy side inefficiency. And we'll see if it wants to work in here and here. We've tried multiple times to get beyond that fair value gap. And we've not been successful in doing that yet. Dollar index is pulling back down into it. Dollar index has a volume imbalance. I don't want to change the charts, but you can do it on your own. There's a volume imbalance on the 1 minute chart using the 1217, 1218 1 minute chart on DXY. So have that on your chart annotated. It might drop down into that. I'd want to see it support there. So sell side here, and then we have consequent encouragement of this wick. You can trade down into there with this SIBI. So we'll drop down to a 1 minute chart, and we'll just finish out our session with this time frame. Almost at that 38.75 sell side. It's also, we have one over here as well. And then digging below that would get us into the levels we just mentioned on the 5 minute chart. I'm looking at Twitter for your feedback when I asked this. The discussion on how to interpret and forecast consolidation days or consolidation sessions. I understand that I probably haven't scratched every itch today because I've talked about a lot of things that probably aren't comfortable or maybe viewed as boring. But at least, did you garner at least that insight on how we can anticipate and forecast consolidation days? Was that clear in, at least in that regard on today's live session? I'm looking at Twitter for your response, by the way. Okay, so think about that right there. That's already 5 handles. And it hasn't even taken the sell side below that low yet. So we had a 5 minute SIBI that it traded up into. And go back to the 5 minute. All of this here. So we traded up into that. Rejecting, going to sell side. So what did it do? It went up into an inefficiency, reaching down into a low. What's below that low? Sell side liquidity. So why would it want to go up here? When the algorithm goes up like this, it's going into this inefficiency. Why would that be useful? Smart money can go short in here. So if they're short inside of an inefficiency, it's not the same as like this high here. That's buy stops being taken when it ran up into that fair value gap again. When it went up into inefficiency, what it's doing is it's allowing traders to have the view or the perception of how I'm teaching you, to use that as a means of being short because it reprices back to an inefficiency in price. So going short there, where's an ideal exit point using the market efficiency paradigm? In other words, who's getting hurt? Who can we use to facilitate a profitable exit or entry? That's the market efficiency paradigm. How smart money cannibalizes everyone else out there. Well, getting short here and targeting that low. That low is a target or draw on liquidity, and being short here on that SIBI, that would be a catalyst for getting short. So inefficiency to liquidity. Dollar's really fallen off. So I'm watching to see if we just poke below that low and then dig up higher into this inefficiency there. So when this was a wick here, and we transferred from the 5 minute down into the 1 minute chart, and it was wicking up in here, between that and just getting to that low, that's 5 handles. If you start looking for those types of moves in the beginning, first of all, you're going to see there's a lot of opportunity just to find 5 handles using the ES. But trusting that you can find them consistently, that takes time. It won't take you much time to get to that point, but you have to keep showing up every day and looking at old moves and studying how it delivered. And when this gets to a point where, how do you know? This is one of the questions I'm going to start asking, and I wish I would have asked the 2 students that I've already done interviews with. How did they know? At what point did they get to where they felt they were ready to trade with real money? And unfortunately, it didn't dawn on me until just now. And you would think that's a really good question. I didn't ask it. I guess in a way I was kind of asking, but I wanted to be more specific. Like, I want to be very clear about how, when I send the outline to them, like when they email me, I have a lot of people that have already emailed me, and I'm answering them in the order I got them. So no one's going to jump ahead. Some of you are saying, hey, I got an email sent to you. Did you see it? I just haven't got to yours yet. Okay, so the one of the questions I'm going to add is, like, what did they feel about themselves? What was the convincing thing for them that led them to the decision of trading with real money or going with a funded account? Because I don't ever teach that. There's no lecture where it says, if you do this, this is how you know. You just know, and you make that decision on your own. So I'd like to know that from everyone that I interview going forward. Like, what was that deciding factor? Because I'm sure most of you would probably love to know what that is too. And not knowing what it would be for you yet. I mean, obviously, if I know what I'm looking for, but what does that really mean for everybody else? Like, what does it feel like? What is it? How do you articulate that? I'm interested in knowing what that is for everyone else. Maybe you don't have the interest in that, but I think it's important. Watch this little area in here. Now, if it would have ran through this low, like when it was right on here, so far it looks like it's the same. Low comes at 75 even. On this candle here, it's 75 even. So we matched that low. If we were able to go through that, and looking at what the dollar's doing right now, I'd feel confident to say we're going to go up above the fair value gap. But we didn't do that, so I'm going to hold that in my pocket. But that's what I would have expected. Like, if we went through here and then had what we show on the dollar now, I would be telling you we're going to go up here next.
but I don't have that here because we didn't take that liquidity out. So that's something also you want to add to your journal. Like some of the questions I get, they'll ask like, how do you avoid taking something? Like what keeps you from taking a trade, or what would cause you to not really see or trust? I guess the better word would be used that way. Um, like what would prevent me from expecting this buy side to be taken with dollar going down? What would prevent that? The fact that we didn't go below to take the sell stops here. I would have preferred, even if it went one tick below that and then did what we see here, then I would look at the SIBI here and treat it as support to send us up into here. But I don't have that here. So I would be waiting for either that to occur or sit on my hands and do nothing and expect just the consolidation to continue. And again, that's something that books aren't being written about. It's not a popular subject matter. No one's making YouTube videos about those types of things. But that's the stuff I want to incorporate, because that's over 30 years. Those are things that I had to wrestle with. A lot of the questions that you ask, they're all questions that I had of myself, my own development. And you don't realize the importance of certain questions that are being asked because you haven't got that far yet in your journey. When you get there, and if you've never heard it, or if it's not available to you, believe me, you're going to ache wishing someone would share how to deal with it. And I'm just that kind of guy. And you're getting it up front. Even though you're kicking and screaming about it most of the times. But it is going on 12:40. So I'll hang with you for another 11 minutes or so. And I'm going to kill it because I'm fasted and I need to eat something. So I think we've had a pretty good overall live session. I know it's not the kind of live session you want, but trust me, we will have the kind of live sessions that you're wanting to see, where it's energetic and price moves and it's like gangbusters. Hang on here, let me see something. Let's go to a 15-minute chart. And let me see this. See what we've done there? Price delivered to the downside, opened on this candle, traded up, bear shorter block, traded down. Next candle here only went up this far, left a fair value gap. So the market has moved from this low here up into that fair value gap. So now we're going to watch. It's in lunch hour. So because we're consolidating, we've tried multiple times to work up here to take that buy side out. We haven't been successful in doing so. And usually lunch, we go into seeking the liquidity that has not been tapped into. We've only done one raid on sell side down here. We've had one buy side taken here, and we had buy side taken here. And we're in consolidation. We've left this low, didn't take that out, and we repriced up into this inefficiency here. Left a tiny little mohawk here. Now I'm thinking, let's watch and see if it wants to deliver down into this low and maybe into the consequent quotient of this wick, and maybe reach for the sell side, and that would be a lunch macro. And the reason why it is outlined why I would favor that versus going up to the buy side is because we've already worked up here multiple times, and we only had one sell side taken here. We didn't even do it on this low. So they punished the shorts by coming back on them multiple times on buy side. So the only people that haven't been messed around with today is anyone that's long that went down here and bought the sell side or bought anywhere in here. Their stop loss is in here. Or maybe they traded up just below here and they feel like they've dodged a bullet or something to that effect. And we're going to watch it and see if I can get it in the next couple minutes. Drop it into a 5 minute. Now you can see how that fair value gap on the 15-minute chart doesn't look so clear, does it? But you always work from your higher time frame down, and you transpose those higher time frame inefficiencies into your lower time frames, and it clears up a lot of the things that doesn't look so clear to you in the charts that are lower time frame. They say that they're noisy. They're not noisy. It's the same price. Price is price. It's still doing everything it was doing in the 15-minute time frame. You're just recording its fluctuations on a smaller time frame interval. So far, dollar's reaching a little bit higher in here. I'd like to see it get above 105. If it does that, we should have no problem getting into that 38.74s. "50-year-old bones cracking." So I'm going to do a poll. If you were looking at this day here, and you've probably been watching price action throughout the morning, maybe you've been watching here and trying to fade me or going along with the ideas that I've outlined. Either way, it doesn't make a difference. Knowing with the benefit of hindsight right now, would you say that this is a day that you would have felt good about participating in, or would this be one of those days you had regretted being a part of? Even if you were right about certain things, would this be a day that you would have been better suited to be doing something outside of trading? And I'm asking that on Twitter, so you can reply to me there. Just send a tweet to me directly. I'm scrolling through looking at them. Jan Zasso, I don't know what you mean by that. You have a real long question. And I'm not trying to do this as a main thing here because I don't like to usually look at Twitter while I'm doing this. But I'm getting ready to wind it down, so I don't mind doing it right now. But you posted, you would really appreciate teaching on where the next weekly CS likely going to expand. I don't know what CS means. So I don't know what that means. I'm trying to think. I don't have anything that I could abbreviate a CS for that I can think off the top of my head. You got a rant all morning, FBG. Dollar index on your hourly chart. You want to take a look at the 8 o'clock from Friday, 8 o'clock in the morning. Your time should be always New York local time, by the way. 8 o'clock in the morning, that candle is a SIBI. It's a fair value gap. We traded up into that. I'm just hanging around in it right now. And there's a lot of buy sides sitting at 105.34 on dollar. So I'm watching to see how we behave here on dollar. We just dropped down into a 1 minute bullish order block and fair value gap. So we'll see if it wants to rip higher and send us down into the consequent encroachment of ES. Very good. I'm seeing some of your responses. This is a day that you would rather be doing something else, like golf. I can't stand golf. I don't understand why people wouldn't play that. But if the weather's nice, I can see how that would be cool. Hang out with your buddies. I just can't imagine beating a small dented ball around on beautiful grass. It doesn't make any sense to me. But it would be better to do something like that than to be trading a day like this. And yes, it's wonderful to see students at least appreciate that. If you know when you're going to anticipate a day like this,
And I think we've effectively done that today, outlining why it should be like this. It's better for you to feel comfortable, not, I mean, like if you go out and you do something else, you're with your spouse, you're with your significant other, you're doing something with your kids. I can be honest and tell you, there's many times I didn't understand this, but I felt every day was going to be a big mover. And when I said to my children, or if I said to my wife, look, I'm taking the day off tomorrow. I'm not going to do anything with the charts. I'm not going to trade. I'm leaving my phone home. Nothing. It's all you. And I was miserable doing whatever I was doing with them. And that sounds horrible, but it's because I didn't know what I'm teaching you today. So this way, when you are doing things apart from the marketplace with your family, or if you're doing something else, that another hobby or something, you won't feel guilty or miss it or feel like you're going to come back and regret having taken a personal time away from the marketplace. It'll give you freedom to just trust it. Who cares what it's going to do? It's probably going to be a really lackadaisical day, lackluster, doing nothing, and it allows you to have the confidence to say, I can step away from this. It's not going to hurt me. It's not going to be a big move. I won't miss anything. And that's one of the benefits of knowing this, because number one, it helps you conquer FOMO, fear of missing out. And you can't appreciate that for those individuals that try to avoid these lessons or these boring, drawn-out lectures. You have to be sitting here watching the price action and then listening to what I've said about it and thinking to yourself, oh, this makes perfect sense. But only the people that sit here and listen to it and see it happen like this can appreciate it. And so then we go forward. When I say we're likely to consolidate, right away, oh, that's one of those days where I can go do something else. And you won't feel guilty about it. You won't fear missing anything. And your attention elsewhere won't be divided. You won't be wondering, man, I wonder what whatever I'm usually trading is doing right now. That was a haunting thing for me. Especially because I'm obsessively compulsive. It would make me short fused. And sometimes I would snap at my wife or my kids when they were just asking to do something. And I'm thinking about, man, I bet you it's doing this or that right now. And they would break my attention from worrying about something I can't even see because I don't have anything in front of me to look at. That's how obsessive I am. And some of you might have that. You have it or you don't. But the way you beat that and the way you cope with it is knowing when these market environments are like this. So that way you don't feel any of that impulsiveness about feeling I have to be a part of it. I got to be plugged in. I got to check my phone. I got to keep my phone with me. No, plug into your family, because that's one of the biggest regrets I have. I lost a lot of time with them doing stupid shit, worrying about these candlesticks when many times it was just like this. And they were days where I thought, because in my ignorance, I thought I had something else forming. I wasted time. Sporting events that my kids were doing, that I should have been there cheering them on as their dad. I'm looking at days like this, thinking, oh, it's going to be a big move. I'm going to be so profitable, and I'm going to show them, and they're going to be thinking, wow, at least you make a lot of money. You didn't come to my game and watch me, Dad, but here, look at this. You made money today. Good for you. That was how I was rationalizing, and that's not even the right way of looking at it. So you can be extremely misguided even if you are successful in this. So you have to make sure that the family's first. I mean, that's why you should be doing it anyway, right? You want your family to benefit from it, but are they really benefiting from it if you're miserable when you're not doing it? At least by having a skill set like this and knowing when it's likely to be choppy, listless, not doing too much, you won't feel all the problems that usually come with wanting to be trading all the time. Well, as much as I love talking, we are 1 minute past, or almost 2 minutes past the time I said I would spend with you. So I've walked you through as much as I could for today. It's doing pretty much what we outlined. It was sitting sideways. Hasn't done much in terms of movement that would be terribly exciting, but we did see some fluctuations. I would be more interested, and this is for your own study, I would be more interested in the 2 o'clock to 4 o'clock. I think you might see something then. Why? Because the market has been going sideways here. Most people are going to be bored by it and do what? Go to the golf range, go whatever, whatever they do outside of trading. I don't know, but in the last hour or so, maybe the last 90 minutes, we'll probably see something that is much favorable in terms of price delivery than what we've seen thus far for today. So I'm going to counsel you to go take a look at that later on today. Get yourself something to eat, stretch out, walk around, get some exercise, and then around 2 o'clock or 2:30 going into the 4 o'clock hour, study ES and see what you find in your price to action study. Any observations, send it to me on Twitter. I'd like to see it, but that's going to be it for today. Let me take a quick look at tomorrow's economic calendar. I don't recall off the top of my head what there is or isn't one tomorrow. Bear with me 1 second. All right, we have unemployment claims tomorrow and Philly Fed manufacturing index. So there might be a little bit of a flurry tomorrow morning. I think what I'll do tomorrow is I'll start streaming at around 8:15, and we'll watch the delivery of the unemployment claims, and we'll carry that into like maybe 9:45, 10 o'clock, and that'll be my second live stream for the week, and that'll be it for this week. And I think that'll be it. Okay, so enjoy the rest of your day, the rest of your evening. Make sure that you have taken some notes, because I've really shared some things in my opinion, in my experience going through all this stuff for as long as I have. What I shared isn't in books, and I wish it would have been taught to me and at least given me a different perspective that you really won't have unless it's being explained to you on how to just let go, let the market have these time of days when you're not a part of it. It's okay. You're not missing anything. These types of days can be missed, and it's okay. Your career will be fine. The importance of knowing how they form, when they form, is when the conditions that create these types of environments or trading days, when you don't have that, then you have the likelihood of a low resistance liquidity run. You don't have that in this condition here. So it's important to know what it is like for it to be next to impossible for a low resistance liquidity run to exist. So it's important that you take that away from today, and then that way when we go forward into our future live sessions, when it's not bringing these types of conditions, you'll see that we can call pretty much every minute ebb and flow of what's likely to occur in this market or any other market. So with that, have a good day, take care, and don't forget to share your observations, even if it's later on in the day or tonight. Show me what you see in the last 2 hours to 90 minutes of today's trading session. Until I talk to you next time, be safe.